Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hi students, in these modules we'll understand about accounting for redemption of preference shares. Now what are preference shares? As you might be already aware, preference shares are those shares which have a priority or which have a preference at the time of payment of dividend and repayment of capital during liquidation or winding up. So when we talk about preference shares, they have a priority or preference over the equity shares or the ordinary shares. So before paying anything to the equity shareholders, either by way of dividend or at the time of winding up when you are repaying the capital, you must first pay the preference shareholders, or you must first pay to the preference shareholder, right? This is what is a preference share. Now in this topic we'll be understanding about what are those regulations and rules relating to redemption of preference shares and how do we do the accounting for that. How to do the issue and how do you account for issue, you would have already learned at the foundation level. Now we are talking about what should be the accounting treatment, how should be the accounting entries when we are actually redeeming those preference shares. Now to give you a perspective, Companies Act does not allow issue of preference shares which are redeemable beyond 20 years. In other words, any preference shares you issue must be redeemed within 20 years. So in India, there is no concept of irredeemable preference shares. Though in theory you may learn it, but practically speaking, there are no irredeemable preference shares. All the preference shares must be redeemed within 20 years. There is a peculiar thing when we talk about redemption of preference shares. Now see, ultimately preference shares are also the owners of the company. Though they do not stay with the company for more than 20 years, they are still categorized as owners, right? Now, if you look at the balance sheet of a company in a T format, on the liabilities side, what all can you see? You can see the equity share capital, you can see the preference share capital, you can see certain general reserves which ultimately belongs to the equity shareholders. Then you can see some liabilities, outside liabilities. They could be secured liabilities, maybe there is a secured loan, or there could be certain unsecured liabilities. These are the broad categorization of things you can see on the liabilities side. On the asset side, you will see a lot of assets. Now, during winding up or during liquidation, when you are actually closing down the company, what will the company do? The company will first realize the assets. You will learn about liquidation in depth when you learn advanced accounting, but for our basic understanding, you will realize or you will sell off all the assets, collect whatever is the cash that is collectible out of that, and then start paying off the liabilities. And friends, there is an order which has to be followed when you repay the liabilities. Whatever you are seeing on the liability side, that is equity, preference, secured liabilities, unsecured liabilities, there is an order prescribed in which these has to be repaid. The first thing that will be repaid out of these four is the secured liability. It could be a secured loan or a secured debenture. So whatever is the security, that will be sold off and that amount will be used to pay off the secured liability. Then you will pay off the unsecured liability. Then you will come to the preference shareholders and lastly you will come to the equity shareholders. I am not talking about statutory dues, workman compensation and all because that will complicate our discussion. You will understand that in detail when you are learning advanced accounting. So out of these four categories, which will be paid first? Secured liabilities, that is the first repayment. Then unsecured, then preference share capital, then equity share capital. Equity will come the last. Now out of these four, number 1 is assigned to secured, number 2 unsecured, number 3 goes to preference, and lastly number 4 is the equity share capital. Now when we are talking about redemption of preference shares, we are talking about a scenario where the company is not being wound up. The company will continue as it is, but we are repaying the preference share capital. What are we doing? We are repaying the preference share capital. Now, if you look at these four people or these four buckets, who should have been ideally repaid first? First repayment should happen to secured, then unsecured, then only you can come to the preference shareholders. But by redeeming preference share capital, what the company is doing is, the company is not paying anything to 1 and 2. The company is directly paying something to number 3. Now look at it from the viewpoint of 1 and 2. Don't you think they'll be upset? Don't you think they'll feel unsecured? Because some asset of the company is being utilized to pay off the preference shareholders. See, finally when you are redeeming, you are reducing the liability towards the preference shareholders, and some of the assets, maybe in form of cash or in form of bank, or maybe you would have sold off some investment, you will reduce that asset or you realize that asset and use that asset to pay off these preference shareholders. 1 and 2 will feel unsecured. 1 and 2 will feel, though we were supposed to get the money first, the company is paying off to the preference shareholders. Now this is a situation which can arise. You are giving priority to number 3, ignoring 1 and 2. And they might feel unsecured. It is very natural. They might be sad about it. They might think that the company is cheating on them. So to take care of these issues, what the Companies Act has done is they have made a provision. They have made a provision to protect the interest of 1 and 2. To protect the interest of outsiders, they have made specific provisions in the Companies Act. Now what is that provision? Now if you look at this 1, 2, 3 and 4, you know that 3 and 4 are something which belongs to the owners. 1 and 2 are something which is to the outsiders. So what the Companies Act has said is, if you want to pay something to this preference shareholders, if you are reducing the quantum of preference shareholders, you either bring in fresh equity or you bring in fresh preference share, or out of the reserves, whatever are free reserves which can be paid to the shareholders, block a specified amount out of that. What is the Companies Act saying? Either bring in fresh share capital, means issue new equity shares or issue new preference shares. If you cannot do that, out of the free reserves which is anyways available as payment for dividend, that means free reserves can be used any time to pay dividend to the shareholders. So out of that free reserves, block a specific amount and transfer that to an account called capital redemption reserve. Block that amount in the company itself so that equity shareholders or preference shareholders cannot get any dividend out of that in the future. So what is the Companies Act in effect doing? If you reduce preference shareholders say by 100 rupees, either add 100 in equity capital or add 100 in preference capital, or out of the free reserves block 100 rupees and keep within the company. Now once this is done, the owner's position is intact and the outsiders who have these secured liabilities and unsecured liabilities, they will feel safer. They will not feel cheated because 100 of preference shares are going out, 100 of new equity shares or preference shares are coming in, or rupees 100 is blocked from the free reserves and kept in a separate account called capital redemption reserve. This is the beauty of redemption of preference shares. How do you protect the interest of others? How do you protect the interest of people who have those outside liabilities? You simply can't say, okay, there is a preference share, I will redeem that. I am giving a priority in repayment. So to ensure that there is enough justice on outside liabilities, Companies Act says either issue new capital or utilize the amount in profit and loss account or in the free reserves and transfer that to capital redemption reserve. Now let us take a couple of scenarios and understand how should the amount be blocked out of the profit and loss account, how are the new shares being issued, and all those aspects. Say there is a company which has preference shares worth of 1000 rupees. What is the preference share value? 1000 rupees. And to redeem those preference shares, the company issued equity share capital of 1000 rupees. What is the equity share capital that is issued now? 1000 rupees. Means there is a fresh issue of shares to redeem the preference shares. Can the company do that? Yes, absolutely the company can do that. Is it required to transfer something out of the profit and loss account and block it as capital redemption reserve? Answer to that is no, because 1000 is what is being redeemed. 1000 is the share capital that has been issued, so there is no need to block any amount in the profit and loss account, right? So it is important to see whether the company has issued fresh shares. Let us take second scenario. The same company, instead of issuing fresh shares and collecting money, it had some investments in shares of some other company. It sold off that shares, collected 1000 rupees, and with that 1000 rupees, it is now redeeming the preference shareholders. Now tell me, is the company required to block something in the profit and loss account? Because you may think the company has actually sold the shares, collected that amount and used it for redemption. Friends, even if the company has sold off the investment, the company must either collect money by issue of share capital, or if it is not able to do that, it has to block the amount in P&L account or in the free reserves and transfer that to the capital redemption reserve. Now in this case, investments are sold, amount is collected, that is perfectly fine. You can use that amount to redeem the preference shares, that is also okay. But because you have not issued fresh shares, you have to transfer 1000 rupees from the profit and loss account and keep it as capital redemption reserve. Are we clear with that? Right. Let's look at the third scenario. Instead of issuing equity shares, the company issued preference shares of 1000 rupees. Now, 1000 rupees of shares have been issued, 1000 rupees of shares will be redeemed. Is there any requirement to transfer amount from P&L to capital redemption? The answer to that is no, because it does not matter. You can issue equity shares, you can issue preference shares. Both of them are acceptable. The only thing is, to the extent you are redeeming the preference shares, you have to issue fresh share capital or you have to issue fresh shares. Then, instead of issuing preference shares, the company has issued secured debentures. The company has issued secured debentures worth 1000, collected 1000 from debenture holders and repaid these preference shareholders. Now in this scenario, is there a requirement to transfer amount from P&L to CRR? Now generally when we see this term, the company has issued debentures, we may tend to think that because the company has issued fresh debentures, there is no requirement of CRR. Friends, that is an incorrect approach. What should be noted is, you have to issue fresh equity shares. If you are issuing fresh debentures, you cannot count it as equity shares, you cannot count it as owner's capital. So you may issue fresh debentures for your money requirement, but if you have not issued fresh equity or fresh preference shares, what you need to do is, you need to block the amount, you need to transfer 1000 rupees from P&L to CRR. So you may issue debentures or you may sell off the investments. If you have not issued fresh equity or fresh preference, then you are required to block amount in the P&L, transfer that to the capital redemption reserve. Now you may say, sir, what do we do with this capital redemption reserve account? Whenever you are issuing bonus shares, you can utilize this CRR account and issue the bonus shares. So see friends, what's happening? Either you are adding to equity and preference now itself by a fresh issue, or you are blocking an amount as CRR and at a future date maybe you will add it back to the equity share capital. So in a nutshell, whenever a redemption of preference share is happening, option number 1, issue equity shares or preference shares. Option number 2, to the extent you are not able to issue equity shares or preference shares, or if you have not issued any shares at all, transfer the amount from free reserves to the capital redemption reserve. Now let's take a small example, with some numbers. So we have equity share capital of 10,000, we have preference share capital of 5,000, there is a surplus in P&L 7,000, and we have securities premium balance of 5,000. Now the company wants to redeem these preference shares at par, meaning to say you will now need to repay to the preference shareholders rupees 5,000. At par means 5,000 is the face value, 5,000 is the amount at which it will be repaid. Now, what are the three things we discussed? Either the company has to make a fresh issue of equity share, meaning to say this 10,000 you have to add 5,000 here. That is one scenario possible. Second, you are reducing preference share capital by 5,000. You can add another new issue by 5,000 here. That is also possible. If you are not able to do this, if you are not able to add equity share capital, or if you are not able to add preference share capital, what you need to do is, from this P&L balance, you have to transfer to CRR. What is the amount? Rupees 5,000. You have to transfer to CRR rupees 5,000, and this CRR one fine day can become your bonus shares. Are we clear? Now, can I use the balance in securities premium account and transfer that to CRR? The answer to that is no. Whenever you are transferring to CRR, you should always look at this P&L surplus or any other free reserves that is indicated in the balance sheet. I cannot use securities premium account to create a capital redemption reserve. I hope the point is very much clear. Now let us add one more dimension to this. Let us now assume that the redemption of these preference shares is happening at a premium, meaning to say I am not redeeming them at face value of 5,000. Let's say I am adding 10% premium. I am adding 10% premium. Now, how much is the amount that will be paid to the preference shareholders? You will pay them preference share capital 5,000, premium 10%, which is 500, a total of 5,500, right? That is the amount you will be paying to the preference shareholders. Now the question is, how much should be the equity share I should be issuing? Should I issue equity shares of 5,000 or should I issue equity shares with this 500 at 5,500? Or if I am issuing preference shares, should I issue 5,000 preference shares or should I issue preference shares worth 5,500? If I am creating a capital redemption reserve, should I transfer 5,000 or should I transfer 5,500? This is what we need to understand very carefully, because if it is a simple at par redemption, I am 100% sure you will not find any difficulty. But whenever this premium component comes into play, there could be a chance that you make a small error and you lose out on valuable marks. So listen to this very carefully. How should the adjustment be done whenever shares are being redeemed at premium? Now I have to provide for redemption of preference capital and also provide for premium on redemption. Now what can I use or how should I approach? Let us first look at the balances we have. In that we have one component called securities premium 5,000. Now where can I use this securities premium? Where should I be able to, as per the Companies Act, for what all purposes can I use this securities premium? That is one thing we need to understand. So let us see where all can we use this securities premium. The first thing where we can use securities premium is to issue bonus shares, right? I can issue bonus shares by using the securities premium. Second thing I can use it is to write off preliminary expenses. The third thing where I can use it is to write off discount on issue of securities or commission paid at the time of issue of securities. The fourth place where I can use it is to provide for premium on redeemable preference shares. And lastly, I can use it to purchase my own shares and securities. Now when I say I can use it to purchase my own shares and securities, it is called buyback of shares, and again that you will understand in detail as a part of your advanced accounting. So these are the 5 things for which I can use this securities premium. Now this is provided by the Companies Act, or this is given in the Companies Act. Now if you look at this list, there is one item in this list which says to provide for premium on redemption of preference shares. I can use it for that. Can I? Yes, but we need to see some other provisions also. Now out of these 5 things that I have just now listed, what Companies Act prescribes is for those companies where accounting standards have been prescribed under section 133. So there are a list of companies where accounting standards have to be complied with, and this largely covers almost all the companies. For those companies, option number 2, that is to write off preliminary expenses, and option number 4, that is to provide for premium on redemption. For specified categories of companies where accounting standard is notified under section 133, for those companies B and D, option number 2 and option number 4 are not available. Meaning to say, a company which is prescribed under section 133 will not be allowed to use securities premium to provide for this premium on redemption. Are we clear with that? So whenever there is a redemption happening, if it is a notified company or if it is a prescribed company, they cannot use securities premium. And friends, for our examination purpose, for our understanding purpose, we will assume that all the companies that we are dealing with are prescribed under section 133, and hence the company cannot use this particular balance to provide for premium on redemption. I hope we are clear with this? Now, since I cannot use this securities premium, from where should I provide this premium on redemption? See, I am paying out something extra. I am creating a new liability. How should I provide for that liability? To which the Companies Act has a one-line answer. And the answer to that is, so the companies have to use the profit and loss account balance or the free reserves balance to provide for this premium. I hope you are able to understand this. So whenever there is premium on redemption, that has to be provided from the profit and loss account. Now, what is the meaning of provided out of profit and loss account? See, finally premium is paid in cash or through bank, right? Now, how do I provide it out of profit and loss account? Let us pass those entries and understand that. Now, when I have to redeem preference shares, I have to create a liability towards preference share holders. So, what is that liability? I will say preference share capital account debit, because I have to, remove preference share capital. I have to remove the capital portion. I have to extinguish that particular liability. I'll debit it by 5,000 and I'll have to credit to preference share holders. How much should the preference shareholders get? 5,000 of capital and 500 of premium. They will get a total of 5,500. Now, what is that balance? That balance is premium on redemption 500. Correct? Premium on redemption 500. Now, this premium on redemption, this has a debit balance. This has a debit balance. If it was not a prescribed company, they could have used securities premium balance to write off this premium on redemption. Meaning to say, you could have debited securities premium, you could have credited premium on redemption, but that is not allowed for prescribed companies. So, what should the prescribed companies do? This 500 should come out of this profit and loss balance. What should you do in that case? You will say profit and loss account debit 500 to premium on redemption 500. This is what we mean using profit and loss account to provide for premium on redemption. So whenever there is a premium on redemption, you have to use profit and loss account only. You have to use profit and loss account only. Make a specific note for this. Don't get confused with what you learn in law, where they say, okay, as per the fourth option, you can use it for providing for premium on redemption of preference shares. That option is there, but for prescribed companies, that option is not there. And in our exams, in accounting paper, we will be dealing only with the prescribed companies. So where will you provide the premium on redemption out of? You will provide it out of the profit and loss account balance. Now, imagine this particular company has not made any fresh issue of shares. What has it not made? It has not made any fresh issue of shares. So in that case, you will have to transfer an amount to CRR. What should that amount be? Should I transfer 5,000 or 5,500? Now friends, if you carefully observe, this 500 I have already provided it out of the profit and loss account, correct? The premium on redemption I have already provided it out of profit and loss account balance, which means I am left out with the balance 5,000. Now for that balance 5,000, again, what did we understand? If we are not issuing fresh equity or fresh preference, you have to block an amount in the P&L and transfer that to the CRR. How does that happen? You will pass an entry, P&L account debit 5,000 to CRR account 5,000. Now, if you look at both of these entries carefully, you repaid the preference shareholders by paying them 5,500. For that, you ensure that you blocked 500 here and you blocked 5,000 here. So, you have blocked that portion of the profit and loss account balance which the company could have used to pay dividend. Now, can the company use this 5,500 to pay dividends? Out of this 7,000, 5,500 is blocked or it has been debited. You can no longer use it to pay dividend. That amount remains within the company. So, this amount which would have been paid out as dividend, which the company could have paid back to the shareholders, the company is withholding that amount and keeping it back with itself. So if you keep back 5,500, so you paid to the preference shareholders 5,500. In return for that, you have blocked 5,500, you have withheld 5,500, and hence the outsiders who have the other liabilities, they will not feel insecure because you paid an amount to the preference shareholders, you paid them 5,500. In return for that, you have blocked 5,500 which you could have paid to the equity shareholders. So this is how you should understand. To summarize, if preference shares are being redeemed at premium, what will be the entry for that? You will debit the preference share capital account, you will debit the premium on redemption, and you will credit the preference share holders account. Now what is the amount with which you will credit the preference shareholders? That is the amount of actual redemption. Then this premium on redemption you will transfer to the profit and loss account, and whatever has been redeemed from the preference share capital, the portion of the face value, if you have issued fresh shares, then no problem. If you have not issued fresh shares, then even that will be debited to P&L and transferred to the CRR account. Now let us take another scenario. Let's say we had to redeem this preference share capital and our equity share capital has a face value of 10 each. Now what the company thought, it was commanding a very good market price and it issued equity shares at 20 rupees. At what price? It issued equity shares at rupees 20. Now how much should be the issue? We know we have to pay 5,000 to the preference shareholders. Now should we issue 5,000 divided by 20, that is 5,000 by 20, this makes it 250 shares, or should we issue 5,000 divided by 10, which makes it 500 shares? See, if I issue 250 equity shares, how much will I collect from the equity shareholders? I'll collect 250 at 20, this makes it 5,000. If I issue 500 shares at 20, this makes it 10,000. I am required to issue equity shares to the extent I am redeeming the preference shares. Now the question here is, should I consider the premium amount also when I am issuing the fresh equity shares? That is the question, which means if I include the premium as a part of my fresh issue, I need to issue only 250 shares, but if I don't consider that, I have to issue 500 shares. Now this is one thing which we also need to understand very carefully. Now the 20 rupees issue price has 10 rupees of face value, 10 rupees of premium. And just now we discussed what are the areas where we can use this premium amount, and did we have redemption of preference shares in that list? We did not have, which means I cannot use this premium amount of 10 rupees per share for the purpose of redemption of preference shares. So if I have to figure out how many shares to be issued or what are the number of shares to be issued, I should always consider the face value only, which means I have to issue 500 shares and collect 10,000. In other words, what we need to ensure is the total face value of the preference shares being redeemed must be equal to the face value of the equity shares which has been realized or which has been collected from the investors. So you should consider only the face value and accordingly arrive at the number of shares to be issued. Premium on issue of equity shares should not be utilized for redemption of preference shares, or it should also not be utilized for premium on redemption of preference shares. I hope you are clear with the logic. To summarize, if you have premium on redemption of preference shares, you have to debit that to the profit and loss account. If you collect premium on issue of fresh shares, that has to be ignored and cannot be used for redemption of preference shares. What you need to ensure is the total face value of the preference shares being redeemed must be equal to the face value of the fresh equity or fresh preference issue. If at all there is a shortfall in this, let's say you have face value of 5,000 of preference shares, when you issued equity shares, you collected 3,000 towards the face value. That means there is a shortfall of 2,000. That 2,000 again must be transferred to the CRR from the profit and loss account. This is a summary of whatever we have discussed so far. As we do problems, we'll be able to understand and appreciate the logic better. Now, let us quickly write down entries for all the transactions we have discussed so far, and we'll be good to start with the illustration. Now we said when you have to redeem preference shares, either you will issue shares or you will utilize the P&L balance and transfer it to CRR. Now if you have issued shares, what will be the entry for that? When you issue shares, you will collect money, you will collect amount in your bank account, your bank balance will increase. So if you are issuing equity or preference shares, what will happen? Your bank balance will increase. So you will debit bank account, and what will you credit? Generally you would have credited it to share application, and from share application you would have transferred to share capital. You would have made the allotment entry, you would have made the first call entry, second call entry. All those would not be required here, because generally the entire issue will happen at once. There will be only a single amount that will be collected, and that amount you can directly transfer to the share capital account. So bank account debited with the amount that has been collected to equity share capital account, to equity share capital account. If you have issued preference shares, we will say to preference share capital account. Now these two will go with the face value, these two will go with the face value, and whatever is the securities premium that has been collected, that you will credit to the securities premium account. So to securities premium account, right? So this is the issue price minus face value, right? That is the first entry. Then you will need to pass the entry for redemption. Redemption means nothing but you are cancelling the preference share capital account and you are creating a liability to the preference share holders. So second entry will be redemption. What are we doing? We are creating a liability towards preference share holders. So you will say to preference share holders account. Now this amount should be the preference share capital plus premium. Whatever is the preference share capital plus premium, that is the credit side of the entry. What will you debit? You have to cancel out preference share capital, and that preference share capital has a credit balance. So what will you do? You will debit that particular account. So preference share capital account debit, and if at all there is a premium, so this will go with the face value. If at all there is a premium, you will debit premium on redemption of preference shares. So this will be the premium portion. And what will you do with this premium portion? The premium on redemption of preference shares will be transferred or will be debited to the profit and loss account. So the next entry for that will be P&L account debit to premium on redemption of preference share. So whatever is that premium, with the same amount you will transfer the amount to the profit and loss account. Then are we done with the entries? We are not yet done with the entries. If at all there was no fresh issue of shares, or if there is a shortfall when you have made a fresh issue of shares, you had to redeem shares worth 5,000, you could collect only 3,000. The balance 2,000 should be transferred from the profit and loss account to the capital redemption reserve account. So let's pass an entry for that as well. For creation of CRR, what will be the entry? You will credit capital redemption reserve. What will be the amount for this? CRR amount will be face value of preference share capital that is redeemed minus face value of fresh issue. So whatever is the preference share capital being redeemed minus the face value of fresh issue, that will be transferred to the CRR account. And what will you debit? You will debit your profit and loss account or your free reserves. So you will debit with the same amount and you will create a CRR account. Now friends, we have discussed these three entries or three set of entries. Whenever there is a redemption that is happening, It can be either fully through issue of fresh shares, that is one scenario. It can be without any fresh issue of shares, that is the second scenario, or sometimes it can be a combination of fresh issue and using part of the P&L balance, right? With this understanding, we'll take a few illustrations and we'll pass the necessary journal entries. Now, finally, you will repay the amount to the preference shareholders. What will be the entry for that? It's a very straightforward entry where you will debit the preference shareholders account and you will credit the bank account. So, write that for payment to preference shareholders. What is the entry? Preference shareholders account debit with whatever is the amount payable to bank whatever is the amount paid, right? With this, we are good to discuss few illustrations. Let us look at an illustration. Hinduja Company Limited had 5,008% redeemable preference shares of rupees 100 each, fully paid up. Now, I want you to pay utmost attention to this word, fully paid up. The reason is, if a preference share is partly paid up, it cannot be redeemed. So, you have to understand, or you have to see in the question and ensure that the shares have been fully paid up, or they were made fully paid up, or if nothing is mentioned and you have to make an assumption, please write a suitable note which states that we have assumed that the shares are fully paid up. Okay. Now, reading further, the company decided to redeem these preference shares at par by the issue of sufficient number of equity shares of rupees 10 each, fully paid up at par. So, very simple, you are redeeming the preference shares at par and you are issuing the equity shares also at par. You are required to pass necessary journal entries including cash transactions in the books of the company, right? So, this is a simple question. What is the requirement of the question? You have to pass the journal entries including the cash transactions, and there are two things that are happening here. One, preference shares are being redeemed. To fund that preference shares or to take care of the redemption of preference shares, you are issuing equity shares at par. Now, how do we pass entries for this? First, we need to figure out what is the amount payable on redemption. So, if you look at the question, it has number of preference shares that is given as 5,000, face value 100, premium on redemption nothing, 0. So, you will have to pay 100 rupees for every preference shares to the preference shareholders, right? So, what is the total amount? Total amount payable is 5,000 into 100, that makes it 5 lakhs. Now, this 5 lakhs is entirely towards face value. This 5 lakh is entirely towards face value. Now, you have to ensure that you issue equity shares and collect 5 lakh towards face value. That's the fundamental principle. What do you need to ensure? You issue equity shares and collect 5 lakh towards face value or collect 5 lakh towards equity share capital. So, face value of equity shares is given as rupees 10. How much do I need to collect? I need to collect 5 lakhs. I need to collect 5 lakhs and each share has a face value of 10. So, number of equity shares to be issued is equal to, you need to collect 5 lakhs, this divided by 10 to make it 50,000. Now, what does this mean? To redeem those 5,000 shares, you need to issue 50,000 shares at par, right? Now, once you have this information in hand, passing the journal entries is a matter of simple logic. What is the first journal entry you will pass? You will pass entry for issue of equity shares. issue of equity shares. Now what will happen when you issue equity shares? You will get amount in the bank. So bank account debit, how much? 5 lakh rupees, right? And you will credit equity share capital account by 5 lakhs, right? Narration, don't forget to write, being issue of how many shares? We know it is 50,000 shares. So 50,000 shares at rupees 10 each. Very simple. Now, since you have issued equity shares and collected 5 lakh towards the face value or towards the share capital, do you need to transfer anything to the CRR account? There is no requirement. Always remember what is the face value of redemption versus what is the face value of fresh issue. If both are equal or if the fresh issue is higher, then you don't need to transfer anything to the CRR account. What is the second entry? Second entry is for redemption. So when you redeem, you cancel out the share capital account and you create a liability towards preference shareholders. So to preference shareholders 5 lakhs, and what will you debit? Preference 8%, preference share capital 5 lakhs, right? What is the narration for this? Being amount payable on redemption of preference shares, right? Then finally you will pay the amount to the preference shareholders. The entry for that will be, whenever you are paying an amount to a party, what will be the entry? You will debit that party and you will credit the bank account. So preference shareholders account debit 5 lakhs to bank 5 lakhs. What is the narration for this? Being amount paid to preference shareholders, right? So with these three entries, your solution is done. Normally you can expect this question for 4 to 5 marks. Now finally you will repay the amount to the preference shareholders. What will be the entry for that? It's a very straightforward entry where you will debit the preference shareholders account and you will credit the bank account. So write that for payment to preference shareholders. What is the entry? Preference shareholders account debit with whatever is the amount payable to bank whatever is the amount paid, right? With this we are good to discuss few illustrations. Let us look at another illustration. C Limited had 10,000 10% redeemable preference shares of rupees 100 each, fully paid up. The company decided to redeem these preference shares at par. They are redeeming again at par by issuing sufficient number of equity shares of rupees 10 each at a premium of 2 rupees per share. You are required to pass necessary journal entries including cash transactions in the book of the company. Now sometimes you may be wondering, why do they specify that you have to pass journal entries including cash transactions? Well, generally cash transactions are supposed to be recorded in the cash book. So if they simply say journal entries, there was a time it seems when candidates used to simply write, or they used to just pass journal entries without cash transactions, claiming that cash transactions should actually go to the cash book. So you will see in every question they will mention journal entries including cash transactions. Well, that is just a separate discussion. Now in this question again, there are 10,000 redeemable preference shares of rupees 100 each, fully paid up. So 10,000 into 100, what is the amount payable to the preference shareholders? Now the question has said that the redemption will happen at par. So what is the amount payable to the preference shareholders? 10,000 into 100, that comes to 10 lakh rupees, correct? So rupees 10 lakh is what is payable to the preference shareholders. Is there any premium on redemption? There is no premium on redemption. Everything is towards the face value. Now the question did not tell you how many equity shares will be issued. What the question told is they will issue sufficient equity shares of face value 10 at a premium of 2 rupees. Now you have to tell me what are the number of equity shares that would be issued. Should I consider 10 lakhs, that is redemption value, should I divide it by 12 or should I divide it by 10? Now we have discussed it already that whatever is the face value of redemption of preference shares, that divided by the face value of the equity share. So in our case 10 lakhs is the value of redemption towards preference share capital, that divided by 10 rupees. So you get a number of 1 lakh. 1 lakh equity shares will be issued with a face value 10 at a premium of 2 rupees. So that is the number of equity shares that would be issued. Always remember, consider preference shares face value divided by face value per equity share. Don't consider the premium amount to arrive at number of equity shares. Our end objective is whatever preference share capital we are redeeming, that must be equal to the face value collected on the equity share capital, or if you are issuing preference share capital, even on preference share capital. So what are the number of shares to be issued? 1 lakh. Now what are the entries that we need to pass? First entry, that will be for issue of equity share capital. What is the amount you will collect from the equity shareholders? Will you collect 10 rupees per share or will you collect 12 rupees per share? We know we are issuing at 10 at a premium of 2 rupees. So you will collect 12 rupees per share. So what is the amount that you will collect? 12 rupees per share into 1 lakh, you will collect 12 lakh rupees. So pass the first entry. Bank account debit 12 lakhs to equity share capital 10 lakhs, that is 1 lakh into 10 rupees, that is the face value, to securities premium account 2 rupees into 1 lakh shares, you get 2 lakh. So what is the entry? Bank account debit 12 lakhs to equity share capital 10 lakhs to securities premium account 2 lakhs, being issue of 1 lakh equity shares of face value 10 each at a premium of 2 rupees per share. That is the first entry. Now let us come to the second entry. Second entry is for the redemption. We are creating a liability towards preference shareholders. How much are you supposed to pay to the preference shareholders? 10 lakhs. So to preference shareholders account 10 lakhs, and what will you debit correspondingly? Preference share capital 10 lakhs. Now if you see the first and the second entry, equity share capital you have credited with 10 lakhs. Preference share capital you are debiting with 10 lakhs. That is what we mean, redeeming preference shares by utilizing proceeds of a fresh issue. So what is the narration for the second entry? Being the amount payable on redemption of preference shares, right? So that is the second entry. And the third entry will be of repayment or actual payment to preference shareholders. So whenever you are paying, you will credit bank account, you will debit preference shareholders account, and narration for that will be being amount paid to the preference shareholders. What is the amount of repayment? 10 lakhs. 10 lakhs debit, 10 lakhs credit. So these three are the entries that you need to pass for this illustration. Now one important thing that you can actually note down in your book is always consider face value of preference shares that is being redeemed, and for fresh issue consider only the face value. Don't consider the premium amount to compute the number of shares. Let us look at another illustration. The board of directors of a company decide to issue minimum number of equity shares of rupees 9 each to redeem rupees 5 lakh preference shares. Now here the number of preference shares are not given. What is given is 5 lakh rupees of preference shares, that is the face value, has to be redeemed. And what is the intention of the board of directors? They want to issue minimum fresh equity shares. Reading further, the maximum amount of divisible profits available for redemption is rupees 3 lakhs. Now what does this mean? We said whenever you have to redeem a preference share, it can either be out of fresh issue, or it can be out of profit available for distribution as dividend, or it can be a combination of both. Now the intention of the board of directors is the first part, that is the equity share, should be the minimum. You should issue minimum fresh equity share, which means we have to utilize the maximum amount available for distribution as dividend, right? Calculate the number of shares to be issued by the company to ensure that the provision of section 55 are not violated. Now what is this provision of section 55? Section 55 deals with issue and redemption of preference shares. Also determine the number of shares if the company decides to issue shares in multiple of 50 only. Now for script writing team, they have written rupees 50, it has to be actually 50 only, right? Now this question is a simple question, we just need to understand the logic and solve the illustration. In this question, what is the face value of preference share capital that is being redeemed? We also call it the nominal value. They have given it to be rupees 5 lakhs. Now we know this can be redeemed, or if you have to redeem this, we have to provide the amount from two sources. One, fresh issue. The second one is from free reserves, right? Now fresh issue plus free reserves should be equal to 5 lakhs. Now the question has mentioned that the fresh issue has to be minimum, which means whatever is the free reserves, in the question it is given as 3 lakhs, I have to utilize this fully. I have to utilize the free reserves fully, and balance amount has to come from free reserves. So what is the balance amount? 3 lakhs out of 5 lakhs, I have to utilize 3 lakhs fully. So fresh issue has to be rupees 2 lakhs, correct? Now this 2 lakhs is the face value of fresh issue. Now they have given in the question equity shares of rupees 9, they have not mentioned any premium, so we can assume that the fresh issue is also at par, that is at 9 rupees. So what are the number of shares? Number of shares will be total face value, that is 2 lakhs, divided by what is the face value per share? Face value per share is rupees 9. So this equals to 2 lakhs divided by 9, that will be 22,222.2. What are the number of shares? 22,222.2. Now I cannot issue a fractional share, so I have to round it off to 22,223 shares, right? So these are the number of shares that has to be issued, so that the issue of equity shares or the number of shares that will be issued will be the minimum, and balance 3 lakhs will obviously come from the free reserves or the general reserve. The second part of the question says, determine the number of shares if the company decides to issue shares in multiple of 50. Now what does that mean? This means if I am issuing any shares, it has to be in multiple of 50, that is I can issue 50, I can issue 100, I can issue 150 and so on. Can I issue 22,223 shares? No. It has to be either 22,200 or it has to be 22,250. Now to comply with the provisions of the Companies Act, minimum requirement is 22 to 23. So the next multiple of 50 is 22 to 50. So the answer will be 22,250 shares. So friends, so far we have been discussing that whenever you have to redeem shares, you have to make a fresh issue of equity shares. Now one more reason why a company would want to make a fresh issue is to get the money required for redemption, correct? Because unless you have the money for redemption, how will you redeem the shareholders? One option is obviously sell off some investment or utilize the amount that is already available with you in the bank. Those are the two sources. Sometimes if that amount falls short, a company may choose to issue equity shares. So a company would be issuing equity shares, first reason being to comply with the provisions of the Companies Act, which says redemption has to be either out of a fresh issue or out of the free reserves balance. That is the first thing. The second thing is to get the funds required for redemption. So even for that purpose, a company may be issuing equity shares. Now let us have a look at another illustration. The balance sheet of X Limited as on 31st March of year 3 is as follows. So they have given you equity and liabilities, share capital 2,90,000, reserves and surplus 48,000, trade payables 56,500. Then on the asset side you have tangible assets, non-current investment 18,500 and cash and cash equivalents, which is your bank, 31,000, right? Now, if you read below, the share capital of the company consists of rupees 50 equity shares of 2,25,000 and rupees 100 each preference shares of 65,000. So, the breakup of 2,90,000 is 2,25,000 of equity share capital, each share is at rupees 50, and 65,000 of preference share capital, each share is at rupees 100. Okay. Reserves and surplus comprises of profit and loss account only. In order to facilitate the redemption of preference shares at a premium of 10%, the company decided the following. First, to sell all the investments for 15,000. Investments are given at 18,500. The company has sold off the entire investments at 15,000. Then, to finance part of redemption from company funds subject to leaving a bank balance of 12,000. So, first you sell investments, you collect some amount from that investment, plus you already have something in your bank account. Both put together you can use for redemption, but the condition being the minimum balance in the bank should be 12,000, right? Then, to issue minimum equity share, again the question here is minimum equity shares of rupees 50 each at a premium of 10 per share to raise the balance of funds required. Now, here you are issuing equity shares primarily as a source of funds to redeem the preference shares. Obviously, when you issue equity shares, the amount you will transfer from P&L balance to CRR will have an impact. No, so this is partly in compliance with the Companies Act provision, but largely to do with the source of funding. So they are issuing equity shares to collect or to get the amount required for redemption of preference shares. You are required to pass necessary journal entries to record above transaction and prepare the balance sheet as on completion of the above transaction. So prepare the, pass the journal entries and prepare the balance sheet. A peculiar issue in this question is the issue of equity shares is primarily for your funds requirement. So that is one thing you need to keep in mind. So let us start solving this problem. First we would need to prepare a couple of working notes and then we are good to go ahead with the solution. So let's prepare the working notes. Working note number 1. We need to determine amount payable to preference shareholders. Don't write PSH in the exam, please write preference shareholders in the exams. Amount payable to preference shareholders. Now, what is the value of preference shares, or what is the nominal value of preference share? Nominal value of preference shares is given as rupees 65,000. Then add, what is the premium? Premium is given as 10%. So premium of 10%, that will be rupees 6,500. 65 plus 6, 71. So rupees 71,500. Total amount payable is 71,500, right? Now, to fund this redemption, you need 71,500 with you. How much does the company have now? The company has a current bank balance of 31,000 only. So, let's prepare another working note. This working note we are preparing to see how many equity shares we need to issue so that we have sufficient money for redemption. So, working note 2, number of equity shares to be issued, right? Now, what is the balance available with the company? Current bank balance is given as rupees 31,000, right? Then, now when you sell the investments, you will collect the amount, correct? So the amount will be collected by the company and the bank balance will go up to that extent. So add amount realized on sale of investments. So that is rupees 15,000. correct? So you have 31,000 of your own balance, 15,000 of what you realized by selling the investments. What is the total available? Total available is rupees 46,000. Can I use this entire 46,000 for redemption? The answer to that is no. The question clearly says you need to maintain a minimum bank balance of 12,000. So, less minimum balance of rupees 12,000. What does that mean? I have 46,000, but I need to keep 12,000 aside for meeting my day-to-day operational expenses or day-to-day funding requirement. So, out of 46, if I keep 12,000 aside, amount available for redemption is 46 minus 12, rupees 34,000. Now, I need to pay 71,500 to the preference shareholders. I can use only 34,000 from my existing bank balance, which means I need to raise the balance amount, right? So, what should I raise? 71,500 minus 34,000. That is the amount I should raise by issuing fresh equity. So, write down amount to be raised by issuing fresh equity is equal to how much? 71,500 payable minus rupees 34,000 what you can use with your from your bank balance. So, 71 minus 34, it gives you 37. So, the amount will be rupees 37,500, right? Now, you have to collect rupees 37,500, and if you see, they said they will issue shares of rupees 50 each at a premium of rupees 10, which means issue price of equity shares is equal to rupees 50 plus rupees 10. This 50 is towards your face value, this 10 is towards your premium. So, you will issue it at rupees 60. What is the amount you need to collect? 37,500. So, number of shares to be issued is equal to rupees 37,500 divided by rupees 60. How much is that? 37,500 divided by 60, it is 625. So, 625 shares must be issued. Now, if I issue 625 shares, what will be the equity share capital amount? 625 into 50 will be the equity share capital amount. This is at face value, and securities premium will be 625 into 10. So, this will be 6250, and 625 into 50 into 50, 31,250. This will be 31,250, right? Now, one thing we need to check is the P&L balance plus this fresh issue sufficient for redemption of those preference shares? That is one thing we need to definitely check before we proceed with the solution. Now, if you go back to the question says 65,000 is the face value of preference shares. So, if I come here, 65,000 is the face value of the preference shares, and I must ensure that I have face value of equity shares plus the CRR, that should be equal to 65,000, correct or not? So, when I make a fresh issue of equity shares, I collected 31,250. I collected 31,250 towards the face value. This amount I can utilize for redemption of preference shares. See, this 31,250 plus 6250, this is towards the fund requirement. This 31,250 is purely towards compliance with the Companies Act provision. So, 31,250 I can utilize from the fresh issue, that is the face value component, and I have a profit and loss account balance of 48,000, which means 31,250 plus 48,000 The sum of these two becomes 250 here, and 4 plus 3 7, 79. 79 250. What is the redemption? The redemption at face value is equal to 65,000. Is it sufficient? Yes, it is sufficient, right? So you have to do this check. Though they have not asked in the question, you have to see that, you have to do this check. What if instead of this being 31,250, this was only, let's say, 11,250, because we had money in the bank? Then 48 plus 11 would become only 59, and we would have had a shortfall. So you have to check both the conditions, fund requirement, also the provisions of Companies Act, which says you can redeem only out of fresh issue or out of balances in the P&L account. Now let us start passing the journal entries considering the various transactions that would have happened, right? Now we have issued how many shares? 625 shares at rupees 60 each. 50 is towards the face value, or 50 is towards the share capital, 10 is towards the securities premium. Let us record that entry. So the first entry will be bank account debited 625 into 60, and how much was that? 37,500 to equity share capital account. This will go with the face value of 50, which we have already computed to be 31,250, to securities premium with 10 rupees, 625 into 10, 6250. So what is the narration? Being 625 equity shares issued at rupees 60, that is 50 towards face value plus 10 premium, right? Now this is the first entry. Now after you have issued the capital, the next thing that you have done is you have sold off the investments, and you have sold off the investments at 15,000. When you sell off investments, you get money to your bank account, correct? So what is the amount that you have received in your bank account? 15,000. So what will be the entry for that? You will debit bank because money has come in, bank account debit 15,000. What will you credit? What is the asset that has gone out? Investments. What is the cost of investments? 18,500. So to investments 18,500. Something worth 18,500 you have given up at 15,000, or you have sold at 15,000. What is that? It is a loss. There is a loss of 3,500. 18,500 minus 15,000. There is a loss of 3,500. So this we call it loss on sale of investments, debit 3,500, being investments sold. Now as you pass these entries, please note what are the transactions that are happening. Now in this particular transaction, bank account debit, so bank balance will increase. Investments account credit, investment balance will come down. Loss on sale of investment, this will go and sit in the P&L. As you remember, or as you keep a mental track of the entries when you are passing those entries, it will be easier when you prepare the balance sheet, right? Now this loss on sale of investment has to be transferred to the profit and loss account. So let us write the entry for that. Profit and loss account debit 3,500 to loss on sale of investments 3,500. So what is the narration for that? Being loss on sale of investment transferred to P&L, right? Now after this, what is the next entry? The next entry will be for redemption of preference shares. Now that we have passed the entry for redemption of preference shares, what do we need to do? We need to do two things. One, the amount of premium on redemption of preference share capital should be transferred to the profit and loss account. Please don't forget that. Whatever is the premium on redemption of preference shares should be transferred to the profit and loss account. And this preference share capital, we have to see how much will come from equity shares, fresh issue, and how much will come to CRR. Whatever is the face value of equity shares, to that extent, you are not required to create CRR. For the balance portion, you will need to create a CRR. So let us pass both these entries. Profit and loss account debit 6,500. This is an entry for transferring of premium on redemption to the profit and loss account. 2. Premium on redemption of preference shares 6,500. So what I am doing is, this 6,500 I am transferring to the P&L account. What will be the narration for that? Being premium on redemption transferred to P&L, right? Then now, out of the face value of preference shares that is being redeemed, what is the amount? The amount is 65,000. How much did we collect towards face value of equity shares when we made that issue? We collected 31,250, which means out of this 65,000, I have collected 31,250 from the equity shareholders towards equity share capital face value, correct? Now, for the balance amount, I have to transfer the amount from P&L and show it under capital redemption reserve. So, let us pass an entry for that to capital redemption reserve. What should be the amount? What is the face value of preference share? 65,000. This is what we are redeeming. How much did we collect towards equity share capital face value? What is the face value portion of equity share capital? We collected 31,250. 65,000 is the preference share that is being redeemed. 31,250 is the face value of equity share capital. What is the difference? Minus 65,000 minus 31,250, 33,750. This is the amount which is not collected by fresh issue, which means this is the amount that has to be blocked in the P&L and you have to create a CRR. So, the amount will be 33,750. You will debit P&L account, you will debit 33,750 and you will credit the CRR account. So, narration will be being creation of CRR to the extent of excess of nominal value of preference share over fresh issue. So, in a nutshell, what I am trying to write in the narration is, whatever is the excess of nominal value over the fresh issue, that is 65,000 minus 31,250, this 33,750 will be the capital redemption reserve. Lastly, I will need to pass an entry for payment to preference shareholders. What will be the entry for that? Preference shareholders account debit by what amount? 65,000 or 71,500? It has to be with 71,500. So, 71,500 debit to bank account 71,500 being amount paid to preference shareholders, right? Now, with this, we are done with the journal entries. Let's now prepare a rough working note to understand how the balances have changed. Now, you are not required to prepare this as a part of your examination solution, but it is good to understand initially, to see where all are the transactions getting affected. So, it's a good habit to make this rough working note, right? So, let's see how will the balances look like. Now, if you go back to the journal entries that we have passed, in the first entry we said we will debit bank account, which means bank balance has changed, right? So first impact is on bank. Now what is the opening bank balance as per the question? They have said cash and cash equivalents. We will assume it is a part of bank, or you can still consider cash and cash equivalents and do this rough working. So bank was 31,000. After the first entry that we passed, we got 37,500. So add 37,500 for this, right? Then in the same entry, we added something to equity share capital. So equity share capital opening balance was 2,25,000 and we added 31,250 to the equity share capital balance. Then in the same entry, we changed securities premium. So securities premium, there was no opening balance, we added 6,250, right? Then we passed an entry, we said we'll sell off the investments. When we sold the investment, we collected 15,000, so that will increase the bank balance. Investments were available at 18,500, everything was credited because we have sold all the investments, this became 0. The next impact came in loss on sale, and that loss on sale was transferred to the profit and loss account. So in the profit and loss account, what was the opening balance? What is the opening balance? 48,000 minus 3,500, the loss on sale of investments. Then we passed an entry for redemption. When we passed an entry for redemption, what happened? We debited preference share capital, which was there at 65,000 minus 65,000, this became 0. Then we also debited something called premium on redemption, which we ultimately transferred to the P&L account. What was the amount? 6,500. So to that extent, my P&L balance will come down. Then we created preference shareholders account, and later on when we paid that preference shareholders account, we credited bank account by 71,500. So I am not writing preference shareholders because that is anyways being cancelled out. Then we created something called as CRR, capital redemption reserve. By what amount? 33,750. So 33,750 is what we created by reducing an amount from the P&L, 33,750, right? These are the set of entries that we had passed, and that is how they have impacted the different balances. Let us quickly compute the closing balances. So you have 31,000 plus 37,500 plus 15,000 minus 71,500. If you say, you get 12,000. Now do you remember in the question we had said minimum balance should be 12,000. Based on that we have prepared a working note. So the closing balance is 12,000. Now we are absolutely sure that our bank account working is proper. Equity share capital 225,000 plus 31,250, 256,250. Now each share is worth 50 rupees. The face value of each share is 50 rupees as given in the question. So if you divide it by 50 rupees, you get 5125 shares. So you can say number also you can mention here, 5125 shares. Now why am I computing the number of shares? The reason I am computing the number of shares is it will be easy to prepare the notes to accounts, right? Then securities premium 6,250, investment became 0, P&L balance is 48,000 minus 3,500 minus 6,500 minus 33,750. So that is 4,250. Now with this we are good to prepare the balance sheet. So now we have the format of balance sheet ready, and in this format we can prepare the balance sheet. Now the first item is shareholders fund. Under that we have share capital, and for share capital we know we have to prepare a note to account. So let's go to the notes to account section. The first note is note number 1 for share capital. Now for share capital we don't have details for authorized, we can leave that column blank or consider whatever has been issued and subscribed, that itself is the authorized capital. Either assumption is fine. So I will simply write authorized, issued and paid up capital, right? How many shares we just now computed? 5125 shares of rupees 50. And what is the amount? 256, 250, write in the outer column 256, 250. Is there any preference share capital? There is no longer any preference share capital, right? So this is the amount that will write in the balance sheet. So come to the balance sheet, 256, 250. Then reserves and surplus, will make note number 2. Reserve and surplus, right? Now what are there in reserve and surplus? First item is profit and loss. What is the balance in profit and loss account? We just now computed it to be 4,250. Now for this you need to prepare a note in the working note or write it here itself. So whatever the rough working we did for profit and loss account, it is relevant and you have to show it as a part of your answer, right? Then we had securities premium. What is the balance in securities premium? 6,250. Then we had capital redemption reserve. What is the balance in CRR? It was 33,750. So write that 33,750. All this put together, 33,750 plus 4,250 plus 6,250, that is 44,250. So that is the total, 44,250. Can come back and write it in the balance sheet, 44,250. Then trade payables, did anything change? Nothing changed. As per the question, it is 56,500. I can write it directly 56,500. Coming to the asset side, tangible assets, did anything change? Nothing changed. As per the question, 3,45,000. Then we had investments, we sold off those investments, so investments will no longer appear. Then under current assets, cash and cash equivalents, for this we will prepare a note, note number 3, balance with banks 12,000. We already computed it as a part of our working note and also as a part of our rough work. Now what you need to note is, in the examination, whatever we did for rough work is relevant for your profit and loss account and balances with banks. You can indicate that in the main solution, right? So now this 12,000, I'll write it up in the balance sheet, 12,000. Now let us total up the balance sheet, 256, 250 plus 44, 250 plus 56,500, that gives you 3,57,000. So total on the equity and liability side is 3,57,000. So this is the total on the liability side. Come to the asset side, 345 plus 12, that is also equal to 3,57,000. Now once you have done all the adjustments properly, once you have given the impact on both the sides means debit side and credit side, there is no question why your balance sheet should not tally. So now we have understood how to create CRR, what are the sources of creation of CRR, and we also saw a problem where we were required to maintain a minimum bank balance. Now sometimes students get confused as to when should we use the face value, when should we use the issue price, right? For that I will be taking certain scenarios, running you through those scenarios for a better understanding as to when should we consider face value and when should we consider issue price for calculating number of shares, right? So first, it's a very simple scenario. We have a balance sheet, equity share capital of 1 lakh, preference share capital of 50,000 and free reserves of 80,000, and we have sundry assets of 1,60,000, cash at bank of 70, the total of balance sheet is 2,30,000. Now assume we have to redeem these all preference shares, the 50,000 worth of preference shares at 10% premium. We have to redeem preference shares at 10% premium. Now what is the value of redemption? The value of redemption will be 50,000 multiplied by 1.1, right, because we are giving it at a 10% premium. So the redemption value will be 55,000. Now this is the amount that you would need to pay to the shareholders, right? Preference shareholders need to get 55,000, and let's assume there is no requirement of minimum bank balance, there is nothing mentioned about fresh issue. Everything has to be done from the existing balance sheet. Now the moment you see that 50,000 worth of preference shares have to be redeemed, the first thing that should strike your mind is, if there is no fresh issue, we need to create CRR of 50,000, correct? if there is no fresh issue, we need to create a capital redemption reserve of 50,000. How will we create that? From this free reserve of 80,000, we will remove 50,000 and create a separate account called CRR account. So, let me do one thing. I'll create one capital redemption reserve which will be worth 50,000. Now, what happens to this 80,000? 50,000 has been transferred to CRR. So, 80 minus 50. So, originally we had 80,000. Now, 50,000 is gone. We are left with 30,000, right? What happens to these preference shareholders? We have paid them 55,000. 50,000 of preference share capital. So, this becomes 0. 5,000 of premium which will be provided from the profit and loss account. So, this will be 25,000. And from the asset side, 55,000 of money has gone out. So, 70,000 minus 55,000, if you do, you are left with 15,000. So, 1,75,000 this side, 1,75,000 this side. If you carefully observe the movement of funds, 50,000 of liability is gone, an additional 5,000 was paid. So, 55,000 has been reduced from this cash balance of 70,000, which takes us to 15,000. And on the equity and liability side, what has happened is preference share, the liability of 50,000 is gone, and in addition 5,000 of premium was paid. So, a total of 55,000 has gone out, 50 from here and 5 from free reserves, and out of 80,000 we have kept aside 50,000 as capital redemption reserve. This is a base case scenario. This is a normal scenario. Now, complexities arise when new shares are issued, or there is a requirement to maintain a minimum bank balance. Now, in this case, the bank balance has come down to 15,000. The question may ask that the bank balance should not fall below some specified number. Let us say the question has mentioned in this case, at least you should have 50,000 in your bank account. So, what is the requirement? Minimum balance should be 50,000. Now, if I attach this condition to this question, first scenario we have understood, if I attach this condition to this question that I need to maintain minimum balance of 50,000 in my bank account, how much do I have? I have only 15,000 after redemption. So, where will I get this balance amount? So, 50,000 minus 15,000, I need 35,000 extra. Where can I get this money from? I can get this money from sale of investment. No information has been given. If asset sale was given or if investment sale was given, we could have sold investment and got the money. Please note, here we have sufficient amount to create CRR. On the free reserve side, there is no problem. We have 80,000. We can create the entire 50,000 as CRR. But because we do not have money, we may issue equity shares. Correct? Because we do not have money, we may issue equity shares. Say for example, we can issue equity shares at a price of 20 per share. So, what is the issue price of equity share? Let me just note it down here. Issue price of equity shares is, let us say, 20. 10 rupee of face value, 10 rupee of premium. Correct? Now, how do I compute the number of equity shares that needs to be issued? Do I need to bother about CRR? I don't need to bother about CRR because CRR requirement is already satisfied. I already have 80,000 in my free reserves. So, I am not issuing equity shares for CRR purpose, but I am issuing equity shares to maintain a bank balance, to maintain minimum bank balance in my account. And what is the balance required? 15,000 is left. If I redeem it as it is, I need minimum 50,000. So, there is a shortfall of 35,000. So, shortfall in bank balance is 50,000 minus 15,000, which is 35,000. I can issue each share as 20. So, how many shares should I issue to collect 35,000? See, the thinking has to change depending on what is the requirement of the question. If it was from the angle of CRR, which we will come to it in the next scenario, we would have taken only face value. But here, I am saying I need 35,000. How will I get this 35,000? By issuing shares at 20. So how many shares should I issue? So the number of shares would be 35,000 divided by 20, which is 1750 equity shares. Please note that in this case, we are bothered about bank balance. We are not bothered that we don't have free reserves. We are bothered that we don't have money. And to make sure that we have sufficient money, we are issuing equity shares. Now, because we have issued equity shares, what would happen? 1750 is the number of shares that has been issued. Face value would be 1750 multiplied by 10 and premium would be 1750 multiplied by 10, right? Now, to this extent of 17,500, there is no requirement to create even CRR. Just link these points. We have issued equity shares to take care of our bank balance, and it is also giving us cushion for creating of CRR. So after all of these transactions, what would happen? You have issued equity shares worth how much? 17,500. So this will be originally 1 lakh plus 17,500. It becomes 1,17,500. Preference shares you have redeemed fully. It became 0. Coming to free reserves, there are multiple adjustments. First, we will tackle the securities premium part. We got 17,500 of securities premium, correct? We got 17,500 of securities premium, which will be shown under reserves and surplus. Now, coming to CRR, I am not required to create CRR of 50,000 because out of 50,000, 17,500 is coming from fresh issue of shares. So my CRR will be 50,000 minus 17,500, which has come from fresh issue of equity shares. So how much is that? Only 32,500. So my free reserves also, the reduction will be 80,000 minus 32,500 minus 5,000 of the premium which I am repaying on redemption. So this becomes 2,10,000, a total on the liability side. Come to the asset side. We have got 35,000 from fresh issue of equity shares. We will add to this. So it is 70 minus 55,000. You will add 35,000 from fresh issue. You get 50,000, right? Now here if you see, we were required to maintain a minimum bank balance, and hence we had to issue equity shares. And to compute how many number of equity shares will be issued, for that purpose we have to consider the issue price, because you are bothered about the amount. You are not bothered about the face value. You are bothered about what is the amount that will come to my bank account. Now in this case, what I will get is 20 per share is what will come to my bank account, and hence I will consider 20 per share to compute the number of equity shares that is to be issued. Now let's do some changes to this example and see when do we consider the face value for calculating the number of shares. Now in the same case, let us assume that free reserves are only 30,000 and sundry assets are worth 1,10,000. We have to redeem preference shares worth 50,000 at a premium of 5,000. Now how much of CRR needs to be created? We need to create CRR for 50,000, right? Because for the face value of shares, we need to create CRR. Do we have sufficient money or do we have sufficient free reserves to create CRR? We have total free reserves of 30,000. We need to create CRR of 50,000. Is this sufficient? No, it is not sufficient. What is the shortfall? Now you may quickly compute and tell 50,000 minus 30,000, 20,000 is the shortfall. But if you look at it carefully, this 30,000 is actually not 30,000. 30,000 and you have to provide for 5,000 of premium on redemption of preference shares. So you are left with only 25,000 and CRR requirement is 50,000. So 50 minus 25, there is a shortfall of 25,000. Don't make this mistake in the examination. Please provide for all expenses, all losses, all premium payable on redemption, and then check what is the balance. So for us, the balance will be 30 minus 5, 25,000. We need CRR of 50. So there is a shortfall of 25,000, right? Now the shortfall can be made good by issuing fresh equity shares. Now for the purpose of calculating how many shares should be issued, will you consider the issue price or will you consider the face value? Once you get the answer to this question correctly, there will not be any confusion. Now please note here, we are issuing shares because CRR requirement is not being fulfilled. There is a shortfall in the free reserves and hence we will issue shares to make good the CRR requirement, and for this purpose we can consider only the face value. In the earlier scenario, we had issued shares because we did not have money. Now to calculate how many shares do we need to issue, we need to check from every share how much amount will we get. We will get 20 rupees per share. So accordingly we will consider the total issue price to calculate the number of shares. But in this case, because we are issuing shares for CRR, we will consider only the face value to calculate the number of shares. So issue price is 20, face value is 10, and so what is the shortfall? We need a CRR of 50, but we have only 30,000 here, and out of this also 5,000 will go towards premium. So there is a shortfall of 25,000. Number of shares to be issued will be 25,000 divided by 10. I am repeating once again, because we are issuing shares for CRR, we will consider the face value for calculating the number of shares. So that becomes 2,500. Now let us see how does the balance sheet look like after redemption. Equity we have 1 lakh already, plus we have issued 2,500 shares multiplied by 10. That gives us 1,25,000. Then we got premium also, right? So 2,500 of premium for into 10. 20 minus 10 is 10. So 25,000 is the premium. Preference share capital is 0. Free reserves 30,000. Out of this 5,000 is towards premium on redemption and 25,000 is towards CRR. And we will create capital redemption reserve of 25,000. Now coming to cash at bank, we had 70,000 plus how much amount will we get when we issue 2,500 shares? Now though we are considering face value for CRR purpose, we will receive the full amount. Investors will pay us 20 per share. So 2,500 into 20 per share, the total comes to 120. Out of this, you will pay back 55,000 to preference shareholders. So you need to remove that minus 55,000. That becomes 65,000 cash at bank, right? So this is how you need to check the CRR requirement and calculate the number of shares that needs to be issued. Now let us do one more change to this example. Let us say that free reserves is 30,000, cash at bank is 30,000, okay, and there is a minimum balance requirement of 30,000. Okay. So let us again revisit this question adding these two conditions. One, there is a current cash at bank of 30,000, and two, there is a minimum balance requirement of 30,000 that needs to be maintained. Okay. So if we change this balance sheet out here, so here instead of 110, let us assume there is 150. Okay. So 180 and 180 is matched. Now let us see how does this example pan out to. Now there are two things we need to check. One, minimum bank balance. Second, CRR requirement. Okay. First, let us check the CRR requirement. For CRR requirement, again, as per earlier case, 50,000 is the redemption value. We have free reserves for 30,000. Out of that, 5,000 will be towards premium on redemption. So we are left with 25,000, which is the shortfall. 25,000 is the shortfall. Now because 25,000 is the shortfall, we will issue 2,500 shares. Okay. Now let us add some computation here. Opening bank balance 30,000. Okay. We have understood that, taken that in the question. 30,000 is the opening bank balance, right? Then receipts from fresh issue. What is the receipts from fresh issue? Based on this calculation on CRR, we will get 2,500 into 20. Redemption 55,000. So to calculate closing balance, opening balance plus whatever you have received 50,000 minus 55,000, you get 25,000. and then there is a shortfall here also. There is a shortfall here also. So, by issuing 2500 shares, though you will meet the CRR requirement, you will not be able to meet the bank balance requirement. So, we need to also check, to meet that bank balance requirement, how many shares do we need to issue? To meet that bank balance requirement, how many shares do we need to issue? Now, for that, you have to do a separate type of a calculation, that is amount required for redemption is 55,000. Amount required for redemption is 55,000. Add minimum balance that you need to keep with you is 30,000. Correct? Minimum balance that you need to keep with you is 30,000. Means the total funds that you should have is 55 plus 30, 85,000. Okay. Funds that you have, existing funds is 30. Funds needed from issue is 85 minus 30, which is 55. Now, you need 55,000 from fresh issue. So, number of shares to be issued will be 55,000 divided by, now here you are calculating in terms of amount needed. You need to maintain the bank balance. You have shifted from CRR requirement to bank balance requirement. So, you will calculate with 20, you get 2750 shares. Here we had got 2500 shares. Now, here we have got 2750 shares. You will have to issue higher of these two. You will have to issue higher of these two. If by issuing 2500 shares, your minimum bank balance was maintained, then this computation was not needed. But because bank balance is not sufficient, now we have to issue 2750 shares. Now, coming to how the balance sheet looks like after issuing these 2750 shares and redeeming the preference shares, how does it look like? Let's have a look at it. Equity share capital, you have initially 1 lakh, right? To this you got 2750 more shares at 10. 2750 more shares at 10. Why at 10? Because for increasing the equity share capital, we will consider only the face value, right? Then preference share capital is 0. Now, free reserves, we will come to it after some time. Securities premium 2750 multiplied by 10, which is 27,500. Now, when it comes to capital redemption reserve, we have to see how much is to be created. Total face value of redemption minus total face value of fresh issue, that is 2750 into 10, that comes to 22,500. Free reserves will have some balance now. 30,000 minus 5,000 for premium minus 22,500 for CRR. So, it has a balance of 2,500, and coming to the asset side, 150 was the opening balance. Cash at bank, we have to maintain at 30. So, opening balance was 30 plus fresh issue 2750 into 20 minus redemption 55,000, 30,000. So, you have 180 this side and 180 this side, right? Now, the only thing that you need to be careful when you handle these kind of problems is you need to check, are you computing number of shares from CRR perspective or from bank balance perspective. If it is from CRR perspective, you have to calculate using face value. If it is from bank balance perspective, you have to calculate using the issue price. And then if there is a conflict kind of a situation, you have to see whichever is higher, those are the number of shares that are to be issued. Let us look at another illustration. The following are the extracts from the balance sheet of ABC Limited as on 31st December of year 1. Share capital 40,000 equity shares of rupees 10 each, fully paid. So, 40,000 into 10, you have 4 lakhs. Then you have 1,000 10% redeemable preference shares of rupees 100 each, fully paid 1 lakh. Now, the reason why they give this specifically fully paid is we have already seen that you cannot redeem unless it is fully paid. So, that is one thing you need to keep in mind. Then they have given balances of reserve and surplus. They have capital reserve 50,000, securities premium 50,000, general reserve 75,000 and profit and loss account 35,000. On 1st of January of year 2, the board of directors decided to redeem the preference shares at par by utilizing the reserves. Now what does this last line mean? When they say that they are redeeming preference shares by utilizing the reserves, it means that they are not making any fresh issue. And as we have understood in our earlier modules, whenever you are redeeming preference shares, either there must be a fresh issue of equity or preference shares, and if you do not issue equity or preference shares, you have to transfer certain portion from the free reserves to the capital redemption reserve. Now if you look at the various balances of reserves and surplus, you have capital reserve, you have securities premium, you have general reserve, and then you have profit and loss account. Now out of these, what can be used to transfer to capital redemption reserve? Only the free reserves. What are the free reserves? General reserve and profit and loss account. These are the reserves which can be used to pay dividends, and they are understood, or they are called as free reserves. So out of these two balances, you have to transfer certain portion to capital redemption reserve. That is one thing you need to keep in mind, because there are no fresh issue of shares. And the requirement is, you are required to pass necessary journal entries including cash transactions in the books of the company. A very simple and a straightforward question. Now whenever you are redeeming preference share, what is the first entry you pass? Now here there is no fresh issue of shares, you are directly redeeming the preference shares. So you are creating a liability towards the preference share holders. So what is the entry you will pass? 10% redeemable preference shares account debit by 1 lakh, that is the face value, to preference shareholders account 1 lakh. Now why 1 lakh? Because preference shares are being redeemed at par. So whatever is the face value, that is the redemption value, and that is the amount of liability you will be creating, being amount payable to preference shareholders at redemption. That is the first entry. Now after you have passed the first entry, what is the second entry? You have created the liability towards preference shareholders. Now you need to pay to the preference shareholders. Whenever you are paying, money is going out of the company. So to bank account 1 lakh, which account will you debit? You will debit the preference shareholders account by 1 lakh. So first entry is to create the liability, second entry is to settle that liability. Now since there is no fresh issue of share, we have to transfer some amount to the capital redemption reserve. And what is that amount? To arrive at that amount, we have to see what is the total face value of preference shares that has been redeemed. In our case, we have redeemed preference shares having face value of 1 lakh. Is there any fresh issue of equity? No. Is there any fresh issue of preference shares? No. Which means this 1 lakh of face value, this is the amount which has to be transferred to the capital redemption reserve. Now out of the balances, we already saw we cannot use the capital reserve, we cannot use the securities premium, so we have to use general reserve and profit and loss account. So whenever you have to use balances, first try to finish out the general reserve, then touch the profit and loss account, unless something else is mentioned in the question. So now when you have to create a CRR, what is the entry you will pass? To capital redemption reserve 1 lakh. Please note, this is the face value of preference shares redeemed to the extent not covered by fresh issue. In this case, there is no fresh issue. So for entire redemption value, we are creating a CRR. So to capital redemption reserve 1 lakh. Now where will this 1 lakh come from? From general reserve 75,000, from profit and loss account 25,000. So debit general reserve account debit 75,000, profit and loss account debit 25,000, being creation of capital redemption reserve at the time of redemption of preference share. So these are the three entries that you are expected to pass. Let us look at another illustration. Now in this illustration, we will combine a fresh issue and we will also transfer some portion to CRR. C Limited had 3,000 12% redeemable preference shares of rupees 100 each fully paid up. So you have 3,000 into 100, 3 lakhs. The company had to redeem these shares at a premium of 10%. It was decided by the company to issue the following: 25,000 equity shares of rupees 10 each at par, 1,000 14% debentures of rupees 100 each. These are the issues that the company is making afresh. The issue was fully subscribed and all amounts were received in full. The payment was duly made. The company had sufficient profits. show journal entries in the books of the company. So they have not told us what is the balance in profit and loss, what is the balance in general reserve. They have simply mentioned that the company has sufficient profits and we are required to pass necessary journal entries. Now, before we start the solution, let us make a small working, figure out how much is payable to preference shareholders, is there any CRR requirement, and then we can pass the journal entries, which is a pretty simple task, right? Now, what is the face value of the preference shares being redeemed? The question has mentioned 3000 12% redeemable preference shares of rupees 100 each. So, face value of preference shares is equal to 3000 into 100, that is 3 lakhs. All the amounts are in rupees. Then, is there any premium payable? Yes, 10% premium is payable to the preference shareholders. So, add 10% premium, that is 30,000. 3 lakhs into 10% is 30,000. So, amount payable to preference shareholders is 3 lakhs plus 30,000, 3 lakhs 30,000. Are we clear with this? This is the amount you will pay to the preference shareholders. Now, to pay to these preference shareholders, the company has made two issues. One, issue of equity shares. Second one, issue of debentures. So, what have they issued? Fresh issue, 25,000 equity shares at rupees 10. So, what is the amount collected? 2,50,000. Now, they have issued equity shares to redeem the preference shares. Can I utilize this amount towards redemption of preference shares? Absolutely yes. Meaning to say, to this extent, to the extent of 2,50,000, I don't need to create any capital redemption reserve. Then, they have also given us that 1000 debentures were issued at 100 each, which comes to 1 lakh. Can I utilize this balance and say that I will not create CRR even for this amount? The answer to that is no. Whenever I am redeeming preference shares, I can utilize amounts collected by fresh issue of equity shares and preference shares. If I am collecting some amount by issuing debentures, I cannot say that I will utilize this amount to reduce my CRR requirement. Okay, whatever you are collecting by issuing debentures cannot be utilized for your CRR requirement or cannot be utilized for redemption of preference share. This is with the perspective of creation of CRR balance. This does not mean that whatever money I have collected, I cannot pay that to preference shareholders. I can pay that to preference shareholders. But just by issuing debentures, I cannot escape from my CRR requirement. Now, in this case, what is the face value of preference shares being redeemed? 3 lakhs. What is the face value of fresh equity shares issued? 2,50,000. So, the difference of these two is the amount of CRR is equal to 3 lakhs minus 2,50,000. That will give me 50,000. So, I need to create a CRR of 50,000 because I have collected only 2,50,000 by issue of fresh equity shares. And always remember friends, you have to compare the face value being redeemed and face value collected afresh. Don't factor in the premium part. I hope you are clear with that. Now, from where will I get this 30,000 of premium? I will get it from the profit and loss account, or I'll transfer this or I'll debit this to the profit and loss account. Because I am paying something extra to the preference shareholders, it is kind of a loss for me. So, I will debit or I'll transfer that to the profit and loss account. Clear? Now that we have done our basic workings, let us start passing the necessary journal entries. What is the first entry we will pass? We will pass an entry for the issue of equity shares. We have issued 25,000 equity shares at rupees 10 each, by which we have collected 2,50,000. When we have collected 2,50,000, we will definitely debit our bank account. So, write down bank account debit 2,50,000. What will you credit? You will credit to equity share capital 2,50,000. Now, sometimes you may have a doubt, sir, why are we not writing share application entry? We can write that. We can write the entry that way also. We can say bank account to equity share application account, and then we can say equity share application to equity share capital account. Both entries are acceptable. So, what is the first entry? Bank account debit to equity share capital account 2,50,000, being issue of 25,000 equity shares at 10 rupees each. That is the first entry. Then we also issued debentures. How many debentures? 1,000 debentures of 100 each. And what is the rate of interest? 14%. So write down the entry for that. Bank account debit 1 lakh because we have issued 1,000 at 100 rupees to 14% debentures account 1 lakh, being issue of 1,000 debentures of rupees 100 each at par. So these are the entries related to issue of equity share and issue of debentures. After that, we have to pass the entry for creating a liability towards preference shareholders. So when you have to create liability towards preference shareholders, what will you write? To preference shareholders. What is the amount? We have already computed 3,30,000. Now this 3,30,000, where will I get this amount from? 3 lakhs comes from the preference share capital account. So debit preference share capital account 3 lakhs. Then the balance 30,000 is nothing but premium on redemption of preference shares. So premium on redemption of preference shares account debit 30,000. So 3 lakhs came from the preference share capital account, or 30,000 is towards premium on redemption. This is a kind of loss which I will later on transfer to the profit and loss account. So, and the total credit to preference shareholders is 3,30,000. What is the narration for that? Being amount payable to preference shareholders at 10% premium at the time of redemption. Right? Now, after you have passed this entry, the next entry will be for payment to preference shareholders. I think by now you are comfortable with that entry. You will debit preference shareholders account 3,30,000 to bank account 3,30,000, being the amount paid to preference shareholders. Now that we are done with all the basic entries, we have two more entries left. The first entry is to transfer the premium on redemption to the profit and loss account. What is the entry for that? Because it's a loss, because you have paid extra to the preference shareholders, you will debit profit and loss accounts. Profit and loss account debit 30,000 to premium on redemption of preference shares 30,000, being premium on redemption of preference shares transferred to the profit and loss account. And lastly, we have to create the CRR. Now they have not given whether it is P&L, whether it is general reserve. So we will assume it is P&L. So you will debit profit and loss account by 50,000. You will credit capital redemption reserve by 50,000, and the narration for that is being creation of capital redemption reserve at the time of redemption of preference shares to the extent not covered by fresh issue of shares. So this is how you will pass the necessary entries. Let us look at another illustration. The capital structure of a company consists of 20,000 equity shares of rupees 10 each fully paid up and 1,008% redeemable preference shares of rupees 100 each fully paid up, issued on 1st of April of year 1. Undistributed reserve and surplus stood as follows. General reserve 80,000, profit and loss account 20,000, investment allowance reserve 10,000, out of which rupees 5,000 is not free for distribution. Securities premium 2,000, cash at bank amounted to 98,000. Preference shares are to be redeemed at a premium of 10%, and for the purpose of redemption, the directors are empowered to make fresh issue of equity shares at par after utilizing the undistributed reserves and surplus. Now in this question, what they are trying to tell us is, you have some balances in the undistributed reserves and surplus. First, utilize that balance, and whatever is the shortfall, for that you can issue equity shares at par. There is a condition that a sum of rupees 20,000 shall be retained in the general reserve and should not be utilized. So, though we have general reserve of 80,000, we cannot use the entire 80,000. We can use only 60,000 because 20,000 is blocked. Out of investment allowance reserve of 10,000, we can use only 5,000, and other free reserves can be fully used. Now, once you get to know what is the amount available out of these free reserves, which can be used to create the CRR, and if at all there is a shortfall after that, for that we have to make an issue of equity shares. Pass journal entries to give effect of above arrangements and show how relevant items will appear in the balance sheet of the company after the redemption has been carried out. Now here we have to break our solution into two parts. First, figure out what is the amount payable to preference shareholders, then figure out how much of CRR can be created, and if there is a shortfall, what is the equity shares to be issued? After that, we are good to pass journal entries and show the balance sheet. Now friends, please note that in this question a full-fledged balance sheet is not available. What we are expected is to give an extract of the balance sheet. Again, let's make a small working note. Firstly, identify what is the face value of preference shares that is to be redeemed. If you look at the question, we have 1008% redeemable preference shares of rupees 100 each. What are the number? 1100 each. So, face value of preference shares is equal to 1000 into 100. That gives us 1 lakh, right? Now, is there any premium on redemption? Yes, 10% is the premium on redemption. So, premium on redemption, that is 10% of 1 lakh, which is 10,000. So, amount payable to preference shareholders is 1 lakh 10,000. Now, once you have done this working, you are good to pass the redemption entry. What would you pass? You would say preference share capital account debit 1 lakh. This will be debited by 1 lakh. This will be debited by 10,000 and this will be credited by 1 lakh 10,000, right? So, see, once you have a structured working note, it is easy to pass the entries. Then, let us see how much of CRR is required to be created. So, whenever we are redeeming preference shares, we know that this 1 lakh of face value should either come from CRR, or we should create a CRR of this 1 lakh rupees, or we have to issue equity shares of 1 lakh, or a combination of both. What does the question tells us? The question mentions that the directors are empowered to make fresh issue of equity shares after utilizing undistributed reserves and surplus. So, for this 1 lakh, what you are expected to do, first create CRR to the extent possible. If there is any shortfall in creation of CRR, then you can go for fresh issue, right? So, our target should be to get the maximum of CRR possible. So, let us see how much of CRR can be created based on the existing balances, right? Second working note, maximum CRR possible. So, let us look at the balances. We have general reserve, total 80,000. What is restricted? The question mentions that we have to maintain a balance of 20,000. So, 20,000 is restricted. What is available? Available is 60,000, right? Then, the second item is P&L account. What is the amount? 20,000 as per the question. Can I utilize the entire amount of 20,000 for creation of capital redemption reserve? Technically, yes, I can utilize the entire balance of 20,000 for creation of CRR. But hold on, out of this 20,000 balance, I have to also provide for premium on redemptions. If you come back to this working note, I have to pay a premium, I have to provide for this premium of 10,000. So, though I have 20,000 of balance in the P&L account, 10,000 I have to set aside for premium on redemption, and only 10,000 is available for creation of CRR. I hope you are clear with this point. Just don't take the entire amount of 20,000 from the P&L account, because you have to also provide for premium on redemption of shares, right? So, in this 10,000 is restricted, not technically restricted, this is for premium. So, the balance available is 10,000. Then we have investment allowance reserve of 10,000. The question says 5,000 is not free for distribution as dividend, which means 5,000 is blocked. I can use 5,000. Then we have balances of securities premium. Can I use it? I cannot use it. Then do we have any other balance? We don't have any other balance. So, out of the reserves available, I can use 60,000 from general reserve, 10,000 from P&L, and 5,000 from investment allowance reserve. So, what is the CRR possible? Maximum CRR I can create is 60 plus 1070 plus 575,000. What is the face value of redemption? face value of preference shares redeemed 1 lakh. What is the shortfall? Is there a shortfall first of all? Yes, there is a shortfall of 25,000. So, shortfall of 25,000. For this 25,000, I have to make equity shares. I have to issue equity shares for this 25,000. I hope you are clear. What are we trying to do? For the 1 lakh of face value of preference shares that is being redeemed, for the 1 lakh of face value of preference shares being redeemed, I am getting 75,000 from CRR, or I am creating CRR to the extent of 75,000, balance 25,000 I am issuing equity shares. I hope you are clear with this logic. How many equity shares? They have mentioned at par. Each share has a face value of 10, so I will issue 2,500 shares. So what will I do? 2,500 at rupees 10. I hope you are clear with this working. Now with these workings, we are good to pass the necessary journal entries. Now let's pass the necessary journal entries. What is the first entry? We are issuing 2,500 equity shares at rupees 10 each. We will pass an entry for that. So the entry will be bank account debit 2,500 into 10, 25,000 to equity share capital account 25,000 being issue of 2,500 shares, equity shares at rupees 10. This is the first entry. Then after we have issued, we have to create a liability towards the preference shareholders. So to preference shareholders, we have computed as per our working note 1,10,000. Correct? 1 lakh of face value, 10,000 of premium. So you will debit 8% redeemable preference share capital count by 1 lakh and premium on redemption of preference shares 10,000. Correct? So being amount payable to preference shareholders. Right? Now once you have created the liability, you have to settle that liability. What is the entry for that? Simply you will debit the preference shareholders account and you will credit the bank account. So for prepayment, preference shareholders account debit 1,10,000 to bank account 1,10,000 being amount paid to preference shareholders. Right? Then after we have paid to the preference shareholders, what are the two things left? First thing left is this premium on redemption of preference share. This has to be transferred to the profit and loss account and then we have to create the CRR. So to transfer premium on redemption, we know it is a loss. So you will say profit and loss account debit 10,000 to premium on redemption of preference shares 10,000. What is the narration for that? Being premium transferred to PNL. Right? Lastly, what is the last entry we have to pass? We have to create the CRR. Let us go back to our working note and see how we should pass that entry. Now, in this particular table, we already have the amount. So, general reserve will be debited by 60,000, PNL debited by 10,000, investment allowance debited by 5,000 and you will credit the capital redemption reserve by this 75,000. Let's pass that entry. So, general reserve account debit by 60,000, PNL account debit. What is the amount? 10,000. Investment allowance reserve account debit 5,000 to CRR or capital redemption reserve account credit 75,000, being CRR created to the extent not covered by fresh issue of shares, right? Now this is how you will pass all the entries. Now after these entries, we are supposed to write, or we are supposed to show the relevant information in the balance sheet. Now what are the information already available in the question? We were given information about the equity share capital. Now if you look at the various entries, equity share capital is increased by 25,000, right? Then they have given information about preference share capital. Preference share capital is gone. You have debited it by 1 lakh. There will be no balance any further. Then we have a lot of information about general reserve. From 80,000 we have removed 60,000. General reserve, from 80,000 we have removed 60,000, balance will be 20,000. P&L, 10,000 removed here, 10,000 removed here, balance is 0. Investment allowance reserve, 5,000 removed, we have balance of 5,000, and we have securities premium 2,000, it will be as it is. And we have cash at bank. Cash at bank was given at 98,000. Now to that 98,000, we will first add this 25,000 and then we will reduce this 1,10,000. Once we have understood this movement in balances, we can straight away prepare the balance sheet. Now in this case, it is not a full-fledged balance sheet, it is just a balance sheet extract. Now coming to the balance sheet, after completing all the transactions, we have the information about share capital. So let us denote it by working note number 1, and as per our usual practice, we will prepare working note number 1 for share capital. We don't have information what is authorized, what is issued, what is subscribed, so we will simply put authorized, issued and paid up. Now the question had given you 20,000 equity shares. Now how many equity shares you have? You have 20,000 plus 2,500. So you can write 22,500 equity shares of rupees 10 each. So that makes it 225,000, 2,25,000. Do we have any preference shares? No. So the total will be 2,25,000. This information you can plot in the balance sheet, 2,25,000. Then the second item is reserve and surplus. What is the note? Note number 2, reserves and surplus. Right. Now under reserves and surplus, the question has given us information about general reserve. How much did we have? We had 80,000. Out of that we used 60,000. So balance is 20,000. Then we have information about P&L. We used it completely, so that will not come. Then we had information about investment allowance reserve. So investment allowance reserve of 5,000. We had 10,000 and we removed 5,000 out of that. We are left with 5,000. Then we have securities premium. Securities premium. What is the balance? The balance given in the question is 2,000. Will that change? It will not change. Then are we left with something else? Yes. We have to also write down the balance of CRR. Just don't take the question and plot it as it is in your answer. Please remember the entries you have passed. You have passed an entry for CRR. So capital redemption reserve of 75,000. So 75 plus 25, 1,02,000. So this is the balance in reserve and surplus. So let's come back to the balance sheet. 1,02,000. We don't have information about current liabilities, no information about non-current assets. Under current assets, under cash and cash equivalents, we have information for bank. So let's put down note number 3. Note number 3, cash and cash equivalent, bank balance. What is the opening balance? 98,000. Then we collected 25,000 and we paid 1,10,000. 1,10,000. 98,000 plus 25,000, that gives you 1,23,000 minus 1,10,000, we are left with 13,000. So 13,000 is this balance. So come to the balance sheet, cash and cash equivalents, 13,000. So are you required to do the totals? No, because it's not a complete balance sheet, so you will not put any total here, neither will you put any total here. It's just an extract of the balance sheet. This is how you are required to compute how many shares can be issued or how many shares have to be issued. The fundamental logic is the same. Compare what is the face value of preference share capital, then check how much of CRR is created and how much has been collected from fresh issue of equity shares. Fresh issue of equity shares or preference shares, again you have to see at the face value. Whatever is the fresh issue at face value plus CRR should be equal to your face value of preference shares redeemed. Let us look at another illustration. The balance sheet of XYZ as at 31st December of year 1 includes the following: 50,000 8% preference shares of rupees 100 each, rupees 70 paid up. So 70 into 50,000, 35 lakhs. Then you have 1 lakh equity shares of rupees 100 each, which are fully paid up, 1 crore. Securities premium 5 lakhs, capital redemption reserve 20 lakhs, general reserve 50 lakhs. So these are the balances as per the balance sheet. Under the terms of the issue, the preference shares are redeemable on 31st March of year 2. Whatever balances we have, that is as on 31st December of year 1, on 31st March of year 2, they are redeemable at 5% premium. In order to finance the redemption, the company makes a rights issue of 50,000 equity shares of rupees 100 each at 110 per share. So now we have an issue of equity shares, that is 50,000 shares that are being issued, face value 100, issue price is 110, which means there is a premium of 10 rupees. Rupees 20 being payable on application, rupees 35 including premium. What was the premium amount? 10 rupees on allotment, and the balance on 1st of January of year 3. So there are quite a few number of dates. We'll put that on a timeline and understand how the transactions have moved. The issue was fully subscribed and the allotment was made on 1st of March of year 2, and the money due on allotment were received by 31st March of year 2. When is the preference share being redeemed? That is also being redeemed on 31st March of year 2. The preference shares were redeemed after fulfilling the necessary conditions of the Companies Act. You are asked to pass necessary journal entries and show the relevant extract from the balance sheet as at 31st March of year 2 with the corresponding figures as on 31st December of year 1. So here we are required to pass journal entries and show the balance sheet extract showing corresponding figures of 31st December of year 1 as well. Now with whatever information we have, because we are dealing with a lot of dates, let us put that on a timeline and then understand how the transactions have flown. First thing we need to notice, we have the balances as on 31st of December of year 1. That is the date for which we have the balances. Then the preference shares are redeemable on 31st March of year 2. So somewhere around here, let's say on 31st of March of year 2, the preference shares are redeemable. So what's happening on this date? 1. Preference share redemption, that is happening on 31st March of year 2. For this redemption, issue of equity shares was made and allotment was done on 1st of March of year 2. So on 1st of March of year 2, equity shares allotted. Correct? Now allotment was done on 1st of March means application or the shares were issued most likely prior to 1st of March. And the allotment money was received by 31st of March of year 2. So second thing that happened was allotment money received. So you redeemed the preference shares on 31st of March. You received the allotment money also on 31st of March of year 2. Now if you have to look at the issue of equity shares, the question mentions you have issue price is what? 110. Out of this 110, 100 is the face value, 10 is the premium, correct? Now, how are these collected? At application stage, we are collecting 20. Are we collecting any premium? No. At allotment stage, we are collecting 35 rupees, which has this 10 rupees of premium included. So, 10 rupees is being collected at allotment stage, and towards face value, we are collecting 25. Then, when is the balance being collected? The balance was collected on 1st of January of year 3. So, final call. So 20 and 25, 45, final call of 55 was collected on 1st of January of year 3. So here final call at rupees 55. Are we clear with the flow of transactions? So by 31st of March of year 2, by this date, what is the amount we have collected? We have collected 20 rupees here, 25 rupees here, 10 rupees towards premium. So can I say by 31st of March, I have collected 20 plus 25 towards face value and 10 rupees towards premium. By this date, this amount has been collected from equity shareholders. Now, why am I doing this breakup? Why am I showing this in a detailed timeline? The reason is that though I have issued shares of face value 100 at 110 rupees, what is the value I have issued at? 110. What is the face value of issue of shares? 100. Did I collect all the amount by 31st of March? That is the precise question. I am repeating my question. Did I collect all the amount from the equity shareholders by 31st March? The answer to that is no. What I have collected is 20 and 25 towards the face value, 10 towards the premium. Balance 55 I am collecting after the redemption of preference shares. When am I collecting that amount? After the redemption of preference shares. So, for the purpose of computation of capital redemption reserve, I can consider only 20 plus 25. That means, whatever I have collected by this date, whatever I have collected by 31st of March, only that amount can be considered for the purpose of computation of CRR. I can't say that I have issued shares worth 100. I can't say that I have issued shares worth 100. I can only say I have collected 45 rupees towards issue of shares, and accordingly I will compute the CRR. I hope you are clear with this particular logic. Now, when I am issuing equity shares, I am calling for application. So, I will have an application entry, I will have an allotment entry where I am collecting the premium amount, then redemption entry, then payment to the preference shareholders, and then creation of CRR and transferring the premium to the profit and loss account. These are the set of entries we are expected to pass. How many shares has the company issued? We know the company has issued 50,000 shares at rupees 110. Now at application stage, what is the amount being collected? 20 rupees per share. So 20 rupees into 50,000. How much amount will be collected? We will collect 10 lakhs at the application stage. At the allotment stage, how much amount will be collected? 50,000 into 25 towards face value. That comes to 12 lakhs 50,000, and 50,000 into 10 towards premium. That comes to 5 lakhs. So total amount at the time of allotment that will be collected is 1250 plus 5 lakhs, that is 17 lakhs 50,000. Now we are good to pass the necessary journal entries for the redemption. Let us get into passing the journal entries. Now let us start passing the necessary journal entries. Now what will be the first entry? Generally you would say, sir, issue of equity shares, right? Because generally we first pass the entries for issuing of equity shares and then we start the process of redemption. But one thing that you need to keep in mind in this question is preference shares are partly paid. Preference shares are partly paid. Can we redeem partly paid preference shares? The answer to that is no. Then how will we redeem that? First we have to make them or convert them into fully paid preference shares. which means we have to make the preference share final call. So first we have to call the amount from preference shareholders, and then only we can start with our regular transactions. So what is the first entry? First entry will be to call the final amount, or to make the final call to the preference shareholders. How many preference shares do we have? We have 50,000 preference shares. What is the amount pending from these preference shareholders? Rupees 30 per share, because out of 100, 70 is paid up, 30 is the balance. So what is the amount that we will call from the preference shareholders? 50,000 into 30, that works out to 15 lakhs. So the first entry will be to make the final call due, right? So pass that entry. 8% preference share final call account debit 15 lakhs to 8% preference share capital account 15 lakhs. Are we clear? So after we pass this entry, from 35 lakhs the preference shares account will now increase to 50 lakhs, right? Now once you have made the call, we assume the shareholders have made the payment. So what is the entry for that? You will collect the amount in bank. So bank account debit 15 lakhs to 8% preference shares final call account 15 lakhs, being amount received from the preference shareholders towards the final call. That is the second part. Then after we are done with making the preference shares fully paid, now we can start with our regular redemption process. What are we doing for redemption? We are issuing equity shares. What is the value at which we are issuing? 110. What is the face value? 100. What is the premium? 10. And what is the amount we are collecting at the time of application? We are collecting 20 rupees per share on 50,000 shares. So what is the entry for that? By now you would have been expert in passing the entries for issuing of equity shares. So what is the first entry? Bank account debit 50,000 into 20, 10 lakhs to equity share application account 10 lakhs. That is the first entry, being application received for 50,000 shares at rupees 20 per share. 10 lakhs debit, 10 lakhs credit. We already did this computation in our working note. That is the first entry. Now, what is the second entry? At the time of allotment, you will transfer this 10 lakhs to the share capital account. So, pass that entry. You will debit equity share application account 10 lakhs to equity share capital account 10 lakhs, being amount towards share application transferred to the share capital account after allotment. Simultaneously, you will also make the entry for allotment due. When you are making the entry for allotment due, we have already done the computation that 12,50,000 is towards share capital and 5 lakhs is towards securities premium. So write that entry. Equity share allotment account debit 17 lakhs 50,000, because this is the amount receivable from the shareholders, to equity share capital account 12 lakh 50,000 to securities premium account 5 lakhs, right? So 12 lakh 50 plus 5 lakhs makes it 17 lakhs 50,000, being amount due on allotment of equity shares. That is the narration. Now after you have passed this entry, what is the next entry? By 31st March, so on 31st March of year 2, you have received all the amount due on allotment. So pass that entry. Bank account debit 17 lakhs 50,000 to equity share allotment account to 17 lakhs 50,000, being amount received from equity shareholders towards the allotment. Are we supposed to do anything for the final call of 55? No, because we are required to prepare the transactions, or we are required to pass the entries till 31st of March of year 2 and prepare the balance sheet also on that day. Final call happened later in January of year 3, so we are not required to pass any entry for that. Now after these entries are passed, we have to find out what is the amount payable to the preference shareholders and is there any CRR requirement. Now let us compute what is the amount payable to the preference shareholders. So what is the face value of preference shares? See, earlier it was 70 rupees per share into 50,000 share. Now it is 100 rupees per share into 50,000 shares, because we have collected that balance 30 rupees also, right? So it will be 50,000 into 100, that is 50 lakhs. So this is the amount, or this is the face value of the preference shares that we are redeeming. Add premium. What is the premium amount? The premium amount given in the question is 5%. 5% of 50 lakhs is equal to 2,50,000. So what is the total amount? Total payable to preference shareholders is 50 lakhs plus 2,50,000. You get 52,50,000. How do you pass the entry? Simply debit this number, credit this amount. That is how we'll pass the entry. Now, are we required to transfer something to CRR? We need to check that. So let us see CRR requirement. Now for that, we need to compare two things. What is the first thing? The first thing to be seen is what is the face value of preference shares that is being redeemed. So we have 50 lakhs. 50 lakhs is being redeemed. The face value of preference shares that is being redeemed is 50 lakhs. How much did we collect from the fresh issue of equity shares? Now for that, you have to carefully see what is the amount collected till 31st of March of year 2. In our case, we collected application and allotment. We clearly know that we cannot use this securities premium part for CRR purpose, right? So that cannot be utilized. So you will have to see only face value. So what is the face value? 10 lakhs here, 12 lakh 50 here. That is what is collected by 31st of March. What we will collect in the future cannot be used for redemption of preference share. So please make a clear note in your answer books that amount collected towards face value on issue of equity shares can be used for redemption of preference share. So for the purpose of computation of CRR also, we have to check what is the face value of shares that has been redeemed and what is the face value collected by issuing equity shares or preference shares. So in our case, we have collected 1250 plus 10 lakhs. The total of these two comes to 22 lakhs 50,000. 22 lakhs 50,000. What is the face value of shares being redeemed? It is 50 lakhs. So CRR requirement is 50 lakhs minus 22 lakhs 50,000. So 50 lakhs minus 22 lakhs 50,000 is 27 lakhs 50,000. This is the value of CRR that is to be created. Once again, to compare, 50 is the total face value of redemption, out of which we collected 10 here and 1250 here. Total collection came to 2250. What is the amount that we have collected towards face value? Now 2250 has been collected. How much should we have collected? 50 lakhs. We collected how much? 22 lakhs 50,000. So the company's act says balance amount of 2750. You have to create a CRR. I hope you are clear with this logic. Now that we have computed what is the amount payable to the preference shareholders and also what is the CRR requirement, we are good to pass the balance entries. So what is the next entry we will pass? On 31st of March of year 2 itself, we will pass the next entry creating a liability towards the preference shareholders. And what is the amount payable to the preference shareholders? We just now computed 50 lakhs plus 2 lakhs 50,000, 52 lakhs 50,000. So two preference shareholders, that is the liability being created, 52 lakhs 50,000. And where did this amount come from? 50 lakhs from the preference share capital account. You will debit 8% preference share capital account, 50 lakhs. Premium on redemption, 2,50,000. To preference shareholders, 52 lakhs 50,000. What is the narration for that? Being amount payable to the preference shareholders at the time of redemption of preference shares at 5% premium, right? What is the next entry? You settle these preference shareholders. So you will debit preference shareholders by 52 lakhs 50,000 to bank account 52 lakhs 50,000 being amount paid to the preference shareholders, right? Now, what are the next two entries left out? One, transfer the premium on redemption to P&L account, and the next one is create a CRR for a value of 27 lakhs 50,000. So let us pass the first entry where we will transfer the premium on redemption to profit and loss account. But in this question, if you see, they have not given us the details of profit and loss account. We do not know whether there is sufficient balance available in profit and loss account or not. Now in such a case, we are free to use the balance in the general reserve, right? So instead of debiting profit and loss account, you will debit general reserve account by 2,50,000 and you will credit premium on redemption 2,50,000. What is the narration for that? Being premium on redemption transferred to the general reserve. And lastly, what is the last entry? You have to create a CRR out of the free reserves. So here again you will use general reserve. So you will debit general reserve account debit 27,50,000 to capital redemption reserve 27,50,000 being capital redemption reserve created as per the requirements of Companies Act. Now with this we are done with all the entries. Now we are good to prepare the balance sheet. Now let's prepare the extracts of the balance sheet as required by the question. Again here we cannot prepare a complete balance sheet because full information is not available. So whatever is the information available, with that we will prepare the extract of the balance sheet. First, do we have the information of share capital? Absolutely yes. So we will prepare a note number 1 for here. Now here we are required to give the information as on 31st of March of year 2 and 31st of December of year 1. So in the notes to account also, you will prepare 31st of March of year 2, 31st of December of year 1. Now, for share capital, we will have note number 1, right? Share capital. Do we have the information of authorized? We don't have, so we will consider whatever has been issued is the authorized capital. So you have authorized capital. What are the number of equity shares that were in issue as on 31st of December of year 1? The question has given us 1 lakh equity shares of rupees 100, correct? 1 lakh equity shares of rupees 100, that comes to 1 crore. Again here all the information are given in mostly in lakhs, so we can also give the amounts in lakhs. So what will write here? Rupees in lakhs. That's what we can put it as a header, and we can save time in writing those extra zeros. So 1 lakh equity shares of rupees 100 each is 1 crore. In other words, it is 100 lakhs. That is in the case of 31st of December of year 1. But by the time we reach 31st of March of year 2, we made an extra issue of 50,000 shares. So let us consider that additional 50,000 is also added to the authorized capital. So what will be the number for 31st of March of year 2? 1,50,000 equity shares of rupees 100. So that comes to 1.5 crores or 150 lakhs, right? Then preference shares, 50,000 preference shares of rupees 100. 50,000 preference shares of rupees 100 each. What is the total? 50,000 into 100, that comes to 50 lakhs. So 50 lakhs here, 50 lakhs here, assuming the authorized capital is retained. Okay, so this is 200, this is 150. Anyways, these numbers don't go into the balance sheet. Then the next thing is to understand issued, subscribed and paid up. So issued, subscribed and paid up. Now as on 31st of December of year 1, how many equity shares were in issue? 1 lakh equity shares, and were they fully paid up? Yes, rupees 100 fully paid up. So 1 lakh equity shares of rupees 100 each fully paid up, So 1 lakh into 100, 100 lakhs or 1 crore, which I can represent as 100 lakhs. What happened to these shares when we came to 31st of March of year 2? They became 1,50,000 fully paid up equity shares. Was that the case? No, that was not the case. But what happened when we reached to 31st March of year 2? These 1 lakh shares remained as it is. We had a fresh issue of 50,000 equity shares. But were these shares fully paid up? The additional shares were not fully paid up. They were only partly paid up to the extent of 45 rupees per share. So 50,000 equity shares of rupees 100 each, rupees 45. So how much is the amount? 50,000 into 45 paid up, that gives us 22 lakhs 50,000. So I will write it as 22 lakhs 50,000. Of course, the 100 lakhs from the opening balance remains as it is, right? Then what is the next item of share capital? Preference shares. Preference shares. How many preference shares did the company have? 50,000 preference shares. So 50,000, 8% preference shares. I'll just write here 8%. 50,000, 8% preference shares of rupees 100 each, rupees 70 paid up. So 50,000 into 70, you have 35 lakhs. So here you'll have 35 lakhs. Are these shares existing as on 31st of March of year 2? The answer to that is no, because we have redeemed everything. This becomes 0, right? So what is the total now for the share capital? 122.50 lakhs for this year and 135 as we closed the previous year. So come to the share capital section. Here it is 122.5 lakhs. Here it is 135 lakhs. So again here I write rupees in lakhs, correct? Now the second note is for reserves and surplus. So for that also we can prepare a note. Second, reserves and surplus. Now under reserves and surplus, what is the information given by the question? What is the balance of securities premium? 5 lakhs as per the question. That is the opening balance. Did we issue some shares at a premium in the current period? Yes. What was the premium collected? 50,000 shares into 10 rupees. We collected 5 lakhs. So this 5 lakhs now becomes 10 lakhs. Securities premium amount is 10 lakhs. Then the next balance given in the question is capital redemption reserve. So capital redemption reserve. What is the capital redemption reserve balance? The opening balance is given as 20 lakhs. The opening balance is given as 20 lakhs. In the current period, we added 27 lakhs 50,000. Check the last entry that we have passed. 27 lakhs 50,000. So 20 plus 2750 makes it 47 lakhs 50,000. Then we have general reserve. Now in general reserve, the opening balance is given as 50 lakhs. From this 50 lakhs, we reduced 2.5 lakhs of the premium that was payable on redemption, and we also reduced 27.5 lakhs of the CRR amount. So current year balance will be, balance as on 31st March year 2 will be 50 minus 2.5 minus 27.5. This will become 20 lakhs. So what is the total? 47 plus 10, 57 plus 20, 77.5 lakhs here and 75 lakhs here. So let's put that in the balance sheet. 77.5 lakhs here and 75 lakhs here. Now one thing that I want you to carefully observe in this problem is we had opening balance of 35 lakhs of the preference shares, which we later on called the final amount, and this became 50. To redeem this 50, we issued or we got 22.5 towards the face value of equity shares, and balance 27.5 was added to this capital redemption reserve. Where did we get that 27.5? We got it from the general reserve, this portion which was removed out of the general reserve. Also, premium on redemption was debited or blocked out of general reserve. Now, if you look at the balance sheet as a whole, from the capital side, though you have reduced this 50 lakhs, though you have repaid this 50 lakhs, you blocked 27.5 here and you blocked 22.5 years. So 22.5 was the fresh contribution by the owners, and balance amount we blocked it from the general reserve, put it under CRR, and this CRR ultimately can be used only to issue bonus shares, right? So you can use this to issue bonus shares. Ultimately this will also go to the capital. So you are trying to keep the capital account, the total capital of the company intact. So this is about redemption of preference shares. Let's look at the next question, which is on redemption of preference shares. The following are the extracts from the balance sheet of ABC Limited as on 31st December of year 1. Share capital 50,000, equity shares of 10, 5 lakhs. Then redeemable preference shares 2 lakhs. Reserve and surplus, capital reserve, general reserve, profit and loss account. And on 1st January, the board of directors decided to redeem the preference shares at a premium of 5% by utilization of reserves, which means they are not making any fresh issue. If they are not making any fresh issue, you have to transfer an amount from the distributable or free reserves to the capital redemption reserve. Now, there are two things here. One, 5% premium. 5% premium on what? On your 2 lakh worth of preference share, which comes to 10,000. This 10,000 will always be debited to the P&L account. The second thing that you have is 2 lakhs, that is the face value of preference share. For this you have to create a CRR, and for creation of CRR you cannot use your capital reserve, you have to use general reserve and P&L. So first preference will be given to general reserve, so that will be an additional entry you will pass by debiting general reserve. So you will debit general reserve and you will credit the CRR by how much? 2 lakhs, that is the face value of the preference shares being redeemed. So let's have a look at one more illustration. The balance sheet of XYZ Limited as at 31st December of year 1 showed the following information. 50,000, 8% preference shares of rupees 100, 70 paid up. So face value is 100 and 70 has been paid up on that. 70 into 50,000, 35 lakhs. 1 lakh equity shares of 100 each fully paid up, 1 crore. Securities premium 5 lakhs, capital redemption reserve 20,000, general reserve 50,000, bank balance 15 lakhs. Under the terms of the issue, the preference shares are redeemable on 31st of March of year 2 at a premium of 5%. In order to finance the redemption, the company makes a right issue of 50,000 equity shares of rupees 100 each at rupees 110 per share, 20 being payable on application, 35 including premium on allotment, and the balance on 1st of January of year 3. So we have gone to year 3 as well. The issue was fully subscribed and allotment was made on 1st of March of year 2. When is the redemption date for preference shares? It is 31st of March of year 2, and application money was received by 1st of March of year 2. The money due on allotment was also received by 31st of March of year 2. The preference shares were redeemed after fulfilling the necessary conditions of section 55 of the Companies Act 2013. Assuming that preference shareholders holding 2000 shares fail to make the payment for the final call made under section 55, you are asked to pass the necessary journal entries and show the extracts of the balance sheet as on 31st of March of year 2 with the corresponding figure of 31st of December of year 1, assuming that the shares in default are forfeited after giving proper notices. Now, one thing we know that whenever we have to redeem shares, we have to make them fully paid up, right? And in this case, the calls were made as per section 55, and shareholders holding 2000 preference shares, they failed to make the payment for the final call. These shares were forfeited and the balance were redeemed, right? So there is a slight twist in the question where they have included forfeiture of shares also. So if you go back to your foundation accounting, you would have understood how do we account for forfeiture of shares. So there is nothing special here. We just need to ensure that the shares forfeiture entry has been passed properly and remaining things are similar to the questions that we have discussed earlier. So let's start solving this particular question. Let's start solving the problem. Now, whenever we have to redeem partly paid preference shares, we have to make a final call for the balance amount, right? Now, date has not been specified as to on which date have they, made the final call for the preference shares. So, we'll not put out any date, but we'll pass the entry for making the final call. So, you have 8% preference shares, final call account, debit by how much? Now, you have 50,000 shares into 30. So, 50,000 50,000 multiplied by 30, you get 15 lakhs. So 8% preference shares final call account, 15 lakhs to 8% preference shares capital account. And how much is that amount? That is also 15 lakhs, being final call of rupees 30 each made on 50,000 preference shares. Please note, writing narration is very, very important. Now, the next entry would be receipt of amount from these preference shareholders, and the question mentions that preference shareholders holding 2,000 preference shares, they did not pay the final call amount, and remaining paid the final call amount. So, whatever money we have received, we will debit the bank account. How much? We had 50,000 preference shares, 2,000 did not pay, and balance paid 30 rupees. So, basically 48,000 into 30, you get 14 lakhs 40,000. That is what you have received. And I hope you remember the concept of calls in arrears. You would have learned that in foundation. If you have not learned, please go back, open your foundation books and understand those entries once again. Whatever amount is not paid in any of the calls, we will park it separately as calls in arrears. So, calls in arrears account debit by how much? 2,000 multiplied by 30. 2,000 shareholders did not pay that amount to 8% preference shares final call account, that is 14 lakh 40 plus 60,000, that gives you 15 lakh. So, you made the final call and you did not get money from 2,000 shares, you parked that as calls in arrears, and remaining amount you received in bank, you got 14 lakh 40,000 in bank. So, this entry is also passed. Now, the question mentions that for these 2,000 shares, proper notice was given and the shares were forfeited. The shares were forfeited. Now, whenever we forfeit shares, what do? To the extent we have received the money, we transfer it to an account called share forfeiture account. We transfer it to an account called share forfeiture account and reverse the entries for calls in arrears and the share capital. So, what will be the entry for forfeiture of shares? You will cancel out the share capital. So, 8% preference share capital account debit. How many shares? 2,000 shares. How much was the amount that we have credited to this preference share capital account? 70 was credited earlier and 30 again was credited with this entry. So, 2,000 into 100, full face value 2 lakhs, that is debited. And what will you credit? You will reverse the calls in arrears and whatever amount has been received so far, that will be credited to share forfeiture account. So, 2 calls in arrears account. How much is that? 60,000. And balance amount or the amount that you have already received, you will transfer to share forfeited account. So, that is 22 lakhs minus 60,000, 1 lakh 40, or the other way to get to this number is 70 multiplied by 2,000 shares. So, this is how you will pass the forfeiture entry. Now, are we reissuing these shares? No, we are not reissuing these shares again, because anyways we are redeeming these shares, right? So, balance shares whatever are left out will be redeemed. Moving on, the next transaction is issue of equity shares. How many shares were issued? 50,000 shares were issued. At what value? 110. But was entire amount receivable immediately? No. You will receive some amount at the time of application, some amount at the time of allotment, and then you can make the calls which will be received in January of year 3. So, first, assuming it has happened in March of year 1, because we don't know the exact date, 50,000 equity share applications were received and 20 per share was received along with the application. So, what will be the entry? You have received the amount in bank. So, bank account debit. How much? 50,000 shares, 50,000 equity shares, and 20 was received on each application. You have received 10 lakh to equity share application count 10 lakhs. You have received 10 lakhs in equity share application account. Please write relevant narration as you know as we solve the problem. I'll also add it here. Amount received on final call from 48,000 preference shares. Being forfeiture of 2,000 preference shares, rupees 70 paid up. Okay. Being receipt of share application money on 50,000 equity shares at rupees 20 each. Okay, that is in respect of equity share application received. When was the allotment made? Allotment was made on 1st of March as per the question. So 1st of March of year 1, the allotment was made. Now, whenever the allotment is made, what do? We transfer the equity share application money to the equity share capital account, and we also make the entry due for allotment. Now, you can combine and make the entry, or you can pass separate entries. So, we can transfer this equity share application money to equity share capital account. Now, you need to be careful here as to what is the face value. The face value is 100. So, this amount, equity share application amount, represents the face value, and if you look in the question also, the premium amount is collected along with allotment. So, this equity share application money has only the amount towards face value of shares. So, the entry will be equity share application account debit by how much? By 10 lakhs to equity share capital account 10 lakhs, being capitalization of share application money. Then on the same date, what happened? On the same date, allotment was made. Now, at the time of allotment, you are not only collecting face value, but you are also collecting premium, right? Along with the face value, you are also collecting premium. So, you will make the entry due for allotment. Equity share allotment account debit will come to the amount to equity share capital account. Now, this will be 50,000 multiplied by 25 and to securities premium 50,000 multiplied by 10, right? Now, the question mentions that allotment amount is 35, out of which 10 is towards premium. So, this will be 50,000 multiplied by 25, that's 12,50,000, and the next will be 50,000 multiplied by 10, that is 5 lakhs. So, 12,50,000 plus 5 lakhs, you get 17,50,000. 12,50,000, this number, plus 5 lakhs, you get 17,50,000, being allotment amount due on 50,000 shares, right? So, this is the entry for allotment due. This has these dates have to be 2, year 2. The question mentions that by 31st of March of year 2, the company has received the amount due on allotment, right? So, what is the amount due on allotment? 17,50,000, entire amount is received. So, bank account debit 17,50,000 to equity share allotment account 17,50,000, amount received on allotment, right? So, this takes care of the entries related to equity share capital. Now that we have received the amount due on equity shares, let us proceed with the redemption. Now please note, out of 50,000 shares, we need to redeem only 48,000 preference shares because 2,000 shares were forfeited, right? So those 2,000 shares which are forfeited, we'll keep that aside and we'll redeem the balance 48,000 shares. So the entry for that would be, so first we'll pass the due entry. You have to pay the amount back to the shareholders. You will debit the preference shares capital account and you will credit the preference shareholders account, right? So 8% preference share capital account by what amount? 48,000 shares into 100, 48 lakhs. What is the amount payable? To preference shareholders account, what is the amount payable? You have to redeem it at a premium of 5%. So 48 lakhs multiplied by 1.05. So you can make a note here as well. 48 lakhs into 1.05. This is how you have computed the amount. 50 lakhs 40,000. And what is the balance amount represent? The balance amount represents premium payable on redemption. So premium redemption of shares, that is 50 lakh 40 minus 48 lakhs, that comes to 2 lakh 40, or you can also do it like 48 lakhs into 5%. Either ways it is fine, right? Now this is the amount payable. Being the amount payable on redemption of 48,000 preference shares at a premium of 5%. Okay. Now you would pay the preference shareholders on the same day, 31st of March of year 2. Preference shareholders account debit by 50 lakh 40,000 and to bank account 50 lakhs 40,000. Amount paid to preference shareholders. Now, after you have repaid the amount, you need to transfer certain amount to the capital redemption reserve to the extent the redemption is not financed by a fresh issue of equity shares. And here please note, though we have issued 50,000 equity shares, we have not got the full amount immediately, or we have not got the full amount as on 31st March of year 2. So only that amount which we have received towards the face value as on 31st of March of year 2, only that will be considered as an exclusion to CRR. So only that amount can be used for redemption. Balance amount you have to transfer from the general reserve and create a capital redemption reserve. I am repeating once again, if you look at the total redemption is 48 lakhs. Out of this, how much have we got from fresh issue? We have got 12 lakh 50,000 here and 10 lakhs here. Only 22 lakhs 50,000 have been received. We will not consider the future amount that we will be receiving. Only what has been received till the date of redemption will be considered. So, on 31st of March of year 2, you will transfer certain amount from general reserve because there are no other reserves available, and general reserve is the first preferred reserve that should be used. How much will we transfer? Let us calculate. General reserve account debit to capital redemption reserve, right? How much is the amount that we will transfer? We have redeemed 48 lakhs worth of preference shares. For this we have received 10 lakhs at the time of share application and another 12 lakhs 50,000 at the time of allotment. So 48 lakhs minus 10 plus 12, 22, 50, 1, 2, 3. You will transfer 25 lakhs 50,000 from general reserve to capital redemption reserve. 25 lakhs 50,000. Being creation of CRR for the amount not covered by the proceeds by the of fresh issue. Okay. So this is the amount that will be transferred to CRR. Then we have this premium on redemption of preference shares. Even that has to be transferred to P&L. We don't have P&L balance, so we will also transfer that to general reserve. So on the same date, general reserve debit. How much is the amount? Amount is 2,40,000. Premium on redemption account 2,40,000. Another option could be debit it to P&L and show it as a negative item of profit and loss account under reserves and surplus. That is also acceptable. So the narration is being premium on redemption written off. So with this we have completed the entries. Now regarding the 2000 preference shares, right, we have not yet cancelled. There is no information that the shares have been cancelled. If at all there is an information that those shares have been cancelled, the balance in share forfeiture account will be transferred to the capital reserve account. If preference shares are cancelled, then you will transfer the amount from share forfeiture account. How much was that amount? 1,40,000 to capital reserve 1,40,000. This entry can be passed if the shares have been cancelled. If they have not been cancelled, or if you assume that they have not been cancelled, then you can carry this share forfeiture account in the balance sheet. Otherwise, this 1,40,000 will move out of share forfeiture and then you will show it under capital reserve. Anyways, the balance sheet total doesn't change in either case. Now what we will do is, we will prepare the balance sheet extracts and show the relevant notes to accounts. So now let's prepare the balance sheet extracts and relevant notes to accounts, right. So under the balance sheet, we don't have much to be shown other than the share capital under the shareholders fund and reserves and surplus, and under current assets the cash and cash equivalents. This is the information that is provided to us in the question and we will present that. Now before we plot the numbers into the balance sheet, we will prepare the notes to accounts, and then based on that notes to account, we will fill up the numbers in the balance sheet. When we are talking about notes to accounts, it is for 31st of December of year 1. So when you are talking about notes to account, the first notes to account will be for share capital, number 1, number 2 for reserves and surplus, and third one for cash and cash equivalents. Now coming to share capital, we don't have the information about authorized capital, so we'll avoid that and we'll start with issued, subscribed and paid up capital. Now in year 1 we had some information and some of those information changed in year 2. Now first one, now in year 1 we had 1 lakh equity shares fully paid up rupees 100, correct. So first one would be 1 lakh equity shares rupees 100 fully paid up, right. So this was there as on 31st of December of year 1, which is 1 lakh multiplied by 100, you get 1 crore. Now this was as on 31st of December of year 1, and for these 1 lakh shares the information has not changed, right. But then do we add the current year fresh issue of shares also to this category? We cannot do that because it is not yet fully paid up. Had that been fully paid up, we would have added that in this category, but because it is not fully paid up, we cannot add that. So this 1 lakh equity shares remain as it is, and apart from this we have 50,000 equity shares of rupees 100 each, out of which rupees 45 is paid up. How 45? 20 at the time of application and 25 at the time of allotment. So 50,000 shares multiplied by 20 plus 25, you get 22,50,000. You can go back to your journal entries and check this particular amount, right. Then we had preference shares, 50,000, 8% preference shares of rupees 100, rupees 70 paid up, right. So this was 70 paid up. As on 31st of December of year 1, it was 50,000 into 70, you get 35 lakhs. As at 31st of March of year 2, on this date, this balance is 0 because we have repaid the preference share capital, or we have redeemed the preference share. So on this date it is 0. Okay. Now one more thing that you need to understand is that out of these 50,000 shares, we redeemed only 48,000 shares. What happened to the balance 2,000 shares? The balance is lying in share forfeiture account. Now we can show it as share forfeiture account here, or if we assume that the shares have been cancelled, we can transfer that to capital reserve and show it under reserves and surplus. Either way it is fine. So we have assumed that it is not cancelled. It is not cancelled. So we will show shares forfeited. How much was that? 1,40,000. So we can sum this up now. 1 crore plus 22,50,000 plus 1,40,000, you get 1 crore 23,90,000, and here you get 1 crore 35 lakh. Now this information you can pull it onto the balance sheet. 1 crore 35 lakhs and 1 crore 23 lakhs 90,000. This completes the share capital part. Now second notes to account we have is for reserves and surplus. Now under reserves and surplus, what are the information we are given? We are told about capital redemption reserve, then we had the securities premium account and general reserve. So capital redemption reserve, securities premium account and general reserve. Now coming to capital redemption reserve, the opening balance given to us in the question was 20 lakhs, securities premium 5 lakhs and general reserve 50 lakhs. This was the information that was given to us, which is 75 lakhs. Now what happened to capital redemption reserve? We added an amount which was not covered by fresh issue of equity shares. So if you go back up, we had this capital redemption reserve, 25,50,000 is what got added. So 20 lakhs plus 25 lakhs 50,000, you get 45 lakhs 50,000. Then securities premium, 5 lakhs was the opening balance and we got 10 rupee per share on 50,000 equity shares, or you can go back and check in your entries as well. We got 5 lakhs additional here. So that makes it 10 lakhs. And general reserve, from 50 lakhs, we transferred out 25 lakhs 50,000 towards CRR, and we also provided for premium on redemption, which was 2,40,000. So we are left with the balance of 22 lakhs 10,000. So what all did we adjust here? This is one number 2550 and 240, which are the amounts which got debited. So if you total these up, you get 77 lakhs 60,000. You can link it back here. 77 lakhs 60,000 and 75 lakhs. Right, now that covers the equity part. Let's go to the cash and cash equivalents. We had a bank balance of 15 lakhs. Now we need to see how much was the closing cash and cash equivalent. So we will prepare a working note for that and also create a note to account. $15 lakhs was there. Let's prepare a working note. Opening balance was 15 lakhs. Add the amount received on preference calls that were made, right? So we got 48,000 into 30, 14 lakhs 40,000. You can go back and check in your entries. Then add, one was preference share final call, then equity share application, that was 50,000 shares into 20. Add equity share allotment. How much did we receive at the time of allotment? 35 per share. So 50,000 into 35, 1750, right. So if you add all of these, 15 plus 1440 plus 10 plus 1750, you get 56 lakhs 90,000 less preference shares redeemed. How many preference shares were redeemed? 48,000 shares of 100 each at a premium of 5%, 50 lakhs 40,000, right. So this is the entry. You can again trace back to your journal entries. Closing balance is 5690 minus 5040, you get 6 lakhs 50,000. So closing balance here is 6 lakhs 50,000. Here also the closing balance is 6 lakhs 50,000, right. So simple problem, nothing complicated, just that there is this twist of share forfeiture, and that is the reason why you should not forget whatever you have learned at your foundation level, because they can just add an adjustment and they can test you in the examination. I remember when I wrote my CA final exams in strategic financial management, they asked a question in which you had to apply elasticity of demand formulae, right. So percentage change in quantity demanded by percentage change in price, that formula had to be applied to derive the price. So they can ask you anything out of your earlier days concepts as well. So don't think that we have finished foundation and we don't need to remember those concepts. Some simple concepts you should remember. In fact, you should remember throughout your career and life as well. So this is all about this question. We have passed the journal entries and also prepared the balance sheet and showed the extracts.